years into the pandemic, a global recovery is underway. Global vaccination rates are improving, and the world is adjusting to a new normal. Yet, the markets remain volatile.
Beijing's crackdown continues. Chinese stocks listed in the U.S. suffering.
The global supply chain is in turmoil. The Fed is rolling out massive stimulus.
We will continue to provide the economy the support that it needs for as long as it takes.
Could soaring debt trigger the next financial crisis? How can investors navigate volatility and uncertainty? Amid the volatility, where is the opportunity? We put this question to the biggest names across finance and economics. This is Bloomberg Invest Global.
Hello, I'm Shonali Basak, Bloomberg Wall Street correspondent. On behalf of Bloomberg, I'm so pleased you can join us on a third day of Bloomberg Invest Global. The economic effects of this pandemic has changed the financial landscape, and today the markets are volatile. There are fee pressures and low interest rates. But in the middle of all this uncertainty, there are opportunities, and our terrific lineup of guests will help you spot them. Before we get started, we have a few tips to help you get the most out of this event. If you have any issues with audio or video quality, try to refresh your browser, or use the chat button in the bottom right corner of your screen for support. You'll be able to submit questions during the interviews, and we hope you do. We want you to engage with us. So if you want to submit a question, please click the white tab on the right side of the video window. If you note your name and geographical location, we'll give you a shout out. And while we may not get to all of you, we'll try our best. And on social media, it's hashtag BloombergInvest. Please use that. And remember, you can connect and engage with other attendees in the event chat that's in the bottom right corner of your screen. I'd now like to take a moment to acknowledge our U.S. presenting sponsor, Invesco QQQ, our presenting sponsors, Abu Dhabi Investment Office, Angola's Investment and Export Promotion Agency, Grayscale Investments, Do Business Jamaica, Letter One, and Qatar Financial Center. And finally, our supporting sponsor, CMC Markets Connect. All right, let's get started. We kick things off with a focus on what's next for global wealth and investing.
Are you ready to grow your business? Venture into one of the strongest and fastest growing economies in the world, Qatar.
Doing business in Qatar is easy, efficient, transparent, and getting simpler by the day.
Get unparalleled market access and support by setting up at Qatar Financial Center. 100% foreign ownership and many, many other benefits.
Hello, I'm Yvonne Mann in Hong Kong, and welcome to Bloomberg Invest Global. For the next 60 minutes or so, we're going to be focusing on what's next in global wealth and investing. To open the session, I'd like to introduce Yousuf Mohamed Al-Jaida, CEO of Qatar Financial Center.
Good afternoon, everyone. It's a pleasure to be here, part of this year's Bloomberg Invest Global, that brings together influential leaders from the finance, economics, and investment landscapes to discuss key issues driving institutional investment strategies. Our participation in this summit comes at an important juncture in time, as the world has effectively started to move into the post-pandemic recovery environment, creating an array of opportunities as well as new industry dynamics for global investors. The economic recovery trend is more visible in Qatar, in part because of how quickly and extensively it responded to the slowdown resulting from the pandemic. In light of such measures, the country's GDP is forecast to grow to $231 billion by 2024 from 193 billion in 2020. With Qatar's commitment to advance its business ecosystem, an increasing number of global investors continue to choose our market to set up their operations, enjoying a range of benefits, facilitation programs, and incentives, such as the robust business infrastructure offered by the Qatar Financial Center. The Qatar Financial Center, which is a leading onshore business and financial center located in Doha, provides an unparalleled business expansion and innovation infrastructure for companies from around the world, presenting an ideal gateway for them to set up locally and expand to the wider markets of Asia, the Middle East, and Africa. The Qatar Financial Center offers its own legal, regulatory, tax, and business environment, allowing 100% foreign ownership, 100% repatriation of profits, and charges a competitive 10% corporate tax rate on locally sourced income. We welcome a broad range of financial and non-financial services firms and currently have over 1,100 registered firms on our platform, with an increasing number of new companies continuing to choose the platform as their gateway to the country. At QFC, we welcome the most vibrant companies across key sectors, including digital, sports, media, and financial services, to invest in Qatar and seize the opportunities available here and build bridges with the wider region. Among others, we have seen a rising number of financial technology companies setting up on our platform, innovating and disrupting in the industry by offering solutions to the most pressing financial services challenges. Responding to the continuing growth in the investment management sector in Qatar and the growing interest among investors from around the world, the QFC continues to offer an innovative and flexible regime for the high net worth segment. The diversity of our solutions and the flexibility of our approach to invest facilitation into Qatar, having positioned us as the go-to platform for businesses willing to venture into the wider Middle East region. Given Qatar's robust economy, there's a great potential for global investors to set up their operations here in Qatar, especially since the country is forecast to witness more growth leading up to the FIFA World Cup 2022 and beyond.
I'm Yvonne Mann from Bloomberg TV. I'm joined here by Nuno Matos, HSBC Wealth CEO here in Hong Kong. Nuno, you were appointed to this job earlier this year. What are your ambitions and vision for China and the region for the wealth business?
Well, Asian wealth is our passion, if you want, as simple as that. And I would start by saying that wealth is by far, in the consumer space, the most compelling opportunity for the financial industry, if you want. Okay, and you have some global factors. For example, the expansion of the affluent population. You have low rates for longer. And you have customers very much educated, trying to look for returns, which today don't exist in normal interest rates, right? But then you also have some regional trends, which are very, very clear. Asian wealth is growing twice as fast as the rest of the world. And you know what? We are the Bank of Asia, right? So it's a compelling opportunity for us, if you want.
You have some pretty ambitious plans for hiring in China in particular. You mentioned you wanted to hire 700 wealth managers on the ground by the end of this year. Are you on track to reach that goal? We
are fully on track. Actually, I would say our plans is to hire 3,000 until 2025. That plan is a 5-year plan. It started this year. This year we were planning to hire 500, and we are going to hire 700. So we are actually accelerating our plans in China.
And who are you actually hiring? Is it more about your senior bankers that can help and target some of the ultra high net worth, or is it more about bankers and targeting the more mass affluent?
All of what you said, it's happening at this moment. We are not targeting the mass market in China, it must be said. We are targeting the mass affluent and the high net worth. So we are hiring private bankers, if you want. We are hiring mass affluent RMs. And we are hiring external sales forces to sell wealth products, example, insurance. And we've been doing that very intensively and very successfully.
The political environment, of course, has been quite interesting, and it's developing as we speak, of course. Given what we've seen with China clampdowns, the tensions that we see with the U.S., what is the sentiment like among your clients right now?
Well, I would say the following. Our clients, in terms of how to invest their assets, are slightly more cautious at this moment. But they are more cautious for real reasons. The pandemic changed the expectations in terms of when the world will go into a full opening, right? Interest rates might be on the rise. We are talking about tapering. Asia as a whole is slowing down a little bit in terms of growth. So I would say it's absolutely normal that our customers became a little bit more defensive. It's not a big change, but undoubtedly they are more cautious. I would say then that we fully believe that they should stay invested because the recovery is real and rates will stay low. But I would say something. In this second phase of the recovery, we need to diversify. Not all assets are going to go up. So we need to diversify and make sure we go for quality assets. You're talking about large caps and high yield dividends, I would go for that.
A common prosperity, that's a big theme in China right now. Have you observed any concerns from your ultra high net worth clients? What questions are they asking you at this point, and how are you advising them during this time?
Well, I would say common prosperity makes absolute sense with Chinese history, right? And you look into the numbers, and it's happening at this moment. Talking about the middle class in China is bigger today than the whole US population. 340 million people in China are middle class. In 25 will be 500,000 people. Then if you talk about mass affluent, we're talking about 30 million, and high net worth 2.5 million. So there is space for all. The market is growing astronomically. For a wealth business like us, this is a compelling opportunity. And I think it works well for high net worth, mass affluent, and mass market. They are all looking for investing their wealth, and we are there for them.
And we've seen a lot of nerves in the markets, whether it's on tech crackdowns in China. You have high yield bonds that are pummeling just based on what the Evergrande crisis has been going on. Have you seen any of your clients want to move their capital overseas?
We did not, and I must say that the wealth story in China is absolutely intact. Okay, and again, this is happening. This growth is happening by the day. The level of growth of middle class and high net worth population is growing at 9% per year. So we don't see a major displacement of wealth stocks from China outside, even though some will happen, which is normal in a world that wants to diversify their wealth.
Does it in any way impact your ambitions on the mainland?
By no means. We are fully in China. We are the leading international bank in China, the biggest international bank in China. We hold the biggest number of licenses in China. We have been there since our foundation for 156 years. We want to be there for the next 156 years, fully committed. I will say that if you go to China with a medium short-term approach for the next 2 quarters, you are in the wrong place. You have to go to China for the long term. That's the right mindset, that's the right approach, and that's what we are doing.
I'm not going to ask you about politics, of course, but of course it has in some way affected your business. There's talks in Hong Kong about a potential anti-sanctions law. We're still not hearing about whether we're going to get it or not. But I have to ask, are you looking at your different clienteles now, whether it's the retail side or whether it's on the other side as well, on how you look at clients right now based on what could be coming, this legislation?
Well, let's put it this way. We understand geopolitics. They're obvious. They impact everybody. They impact companies, they impact us, they impact customers. But we know what we can manage and what we cannot manage. What we can manage is our customer business. And that's what we're focused on, managing our customer business and delivering to them the right products and services.
Now, how do you manage it when there's directives from both sides, from legislation from the US as well as China? Is there a way to appease both sides while you do business?
We continue to focus on our customer needs, as simple as that, because that's the only thing we can manage.
Does it change how you view different wealth hubs outside of China, for example, like Singapore? How attractive a market is that for you?
Very attractive, but I would say for us, it's never about Hong Kong or Singapore. For us, it's Hong Kong and Singapore and Asia. It's about winning in Asia. Hong Kong and Singapore, by the way, they are the second and third cross-border markets globally on the wealth space. We don't want to be out of that. And by the way, they are only below Switzerland. But by 2025, Hong Kong will be the #1 cross-border wealth hub. And Singapore is the fastest growing. We want to be there, and we want to do that to connect the world with those wealth hubs. Hong Kong is very important to mainland China, very, very important. And the GBA region initiative is just opening a world of opportunities for us. Singapore is very important for the Asian connectivity, the Asian region connectivity, for the Middle East, and is actually very vibrant as a financial hub. We just recently announced an acquisition in Singapore of AXA which for us is a tremendous play because we are doubling down on our insurance business. We are getting scale on the life insurance business. We are getting a better position on the health business. And we are getting an external sales force which we didn't have. So for us is Hong Kong, Singapore, and frankly, all the wealth hubs in the world where we are present. And that's what we are doing.
Yeah, your CEO, Noel Quinn, talked about that during the latest earnings report, saying that they're looking at some small bolt-on acquisitions. You mentioned about Access Singapore. What are some other targets that you're looking at in this region?
Well, I would say the first thing, as an obvious one, 90% of what we are going to do is going to be organic. We have the right to win. We have the customers. We have the segments. We have the capabilities. We are full asset management in place. We have full insurance in place. We have full private banking in place. So we have the right to win just by growing on top of what we are. Having said that, if we look into an opportunity which will accelerate our strategy or will allow us to gain scale in one market, we'll go for it. So we are planning for 4 or 5 small bolt-on acquisitions, which will increase our wealth ambitions in our Asian top markets, which I would say are Hong Kong, mainland China, India, and Singapore. I will not tell the names, obviously, but I would say we hope that will happen soon.
Is part of your scope looking at some of these more kind of boutique private banking shops in the region? Is that something that you're looking at as well?
We are not looking for boutiques specifically. We are looking for businesses that will expand our scale in the market. We are looking for elements that add into our capabilities. I would not call it boutiques. I would call it capabilities expansion of scale.
Outside of China, we talked a little bit about Singapore, but beyond that, what are some other markets that you think have the most growth runway here right now? What are you most interested in?
So I'll repeat it. In Asia, our top 4 markets are Hong Kong, and obviously we are the dominant bank in Hong Kong, if you want. Is about mainland China. We are the leading bank in China, international bank in China, if you want. Singapore, we want to continue to grow our already meaningful position in that market. And India, it's a huge market. It's a wealth story at this moment. Wealth is growing at 10-20%, depending on the industry in India. We have a small presence in India on the wealth side. We want to find our way into a more ambitious size in India.
And what kind of timeline do you have for that? Do you set your targets on that?
We set our targets for the next 5 years, okay? And in the next 5 years, we want to be the leading wealth manager in Asia. And that's a bold ambition we want to deliver.
You mentioned a little bit about kind of your clients are a bit cautious right now, rightfully so. We mentioned about the tension that we're seeing in markets, whether it's for what we're seeing in China today, we're seeing quite a bit of a sell-off here when it comes to concerns about inflation. What are your wealthy clients investing in particular? Are there specific global trends and regional trends that you're advising them that you're seeing right now?
Yeah, well, I can talk generic about what they are doing, right? But the first thing I would say is that every customer has been anxious to get some returns. In a very low interest rate environment, that's tough, right? And the traditional banking products, like a term deposit, does not serve anymore to protect your wealth because it just is consumed by inflation, right? So I would say that on the fixed income space, yields are extremely low, that's obvious. There is still some space on the emerging market bonds and on the high yield bonds, okay? And then for the wealthiest customers, a new avenue, which is, if you want, growing by the day, is what we call the alternative space. We're talking about real estate investments, private equity, private credit, hedge funds. This is a new range of products for that population, ultra high net worth, that is really embracing, if you want, this need for higher returns. Also higher risk, you must say. And then Asian customers, by the way, which were always traditionally very domestic buyers, they are now looking into diversify globally, as they also see the Asian economy slightly going down a little bit, slowing down. But they have been very disciplined in terms of thematic and new economy trends. So they are looking into smart manufacturing, healthcare, renewables, electric vehicles, just to name some of it. Yeah.
ESG?
ESG, I should have said it immediately. It's a wave, by the way. It's an exponential wave that is going through the market. And that's a place where we want to be one of the leader investors, one of the leader providers of sustainable investment for that population. ESG is an obvious need. We know that the planet is not sustainable. The planet needs to be transformed, okay? And this generation, talking about our generation, is called into action. And we have this decision to make, which is, are we going to be the generation that's going to save the planet, or we'll leave it to the next one, which will be too late, to be frank. So our bank takes this very, very seriously. We want to be the one financing the transformation, financing the transition of our customers, companies and individuals. Last year, we announced, for example, our policy, very clear policy. We want to be net zero on our operations by 2030. We want to be net zero on our customer portfolios by 2050. And we are committing to $1 trillion of investments into sustainable investments. What is very curious is that our customers, our consumer customers, are starting to be very much aware of this equation. We did some research. 3 in 4 of our retail customers of all segments, they want to know more about how they can place their money to more sustainable options. And 50% of our wealthier customers, mass affluent customers, they actually believe that in 3 to 5 years, all their holdings will be in sustainable investments. So we are delivering to that. We are creating by-the-day capabilities, funds, discretionary mandates that only focus on sustainable investment. We are also doing simple things like all our credit cards and debit cards are now in recycled plastic. That will be completed by 2026. Yeah. And we are doing this to become a leading sustainable investment bank.
Yeah, you're new to Asia, so I think you're looking at the business in a different lens. I have to ask before we go, the biggest risk to the business right now, what would that be?
Well, the biggest risk is the lack of ambition, which we don't miss. We have a lot of ambition to grow, okay? And then, as I always say, the macroeconomics obviously determine a lot what we can do in banking. But we cannot manage macroeconomics. So we focus again on the things we can manage. And what we can manage in HSBC is the ambition, the passion we have for wealth, for example.
Are you concerned about a slowdown in China that we see right now?
China is slowing down slightly. It's a fact. We see that on the PMI and trade data. China also had to restart the economy, or is not restarting the economy because of COVID. So obviously it was expected that China would not pick up in growth. Having said that, we believe that in 2022, China will be growing again above 5%, probably 5.6%, which is very respectable. We will see the infrastructure investments going up. We see more fiscal stimulus going into the economy, central and local. So we don't think China will slow down further than what it did. So we are very positive again in China.
Nuno, thank you so much for joining us.
Thank you. It was a pleasure.
Yeah, appreciate it. Thank you so much.
Thank you, Mark. Thank you so much for joining us. Let's start off with the good. Last year, you had such a strong year when it comes to returns. In fact, I think you called it pretty much a perfect year. Are you managing expectations in terms of what's achievable this year?
Yeah, we always try and manage expectations down, really. When I go to the member briefings, they say, oh, here he goes again. He's going to tell us we won't have as good numbers as last year. So last year, we earned over 20%, which was our best return ever. And on a large amount of money, really. But the thing that staggers me is that we've had great returns for over a decade now. For the last 10 years, the balanced plans earned 9.7%. So it's been a great environment for investing right through the whole last decade. And we tend to forget that with the ups and downs of COVID or European debt crisis or something else. But last decade's been phenomenal for investing.
The European debt crisis just feels like a long time ago. It's really interesting what a couple of years of this pandemic does to your perspective, right? Is it time to get defensive, though? Because I think when we spoke to you in the middle of this year, you had said, look, yes, higher interest rates, tightening monetary policy might prove to be a bit of a headwind, but it's not enough for you to take a defensive position yet. Has that changed, given that we've had concerns over China, potentially an energy crisis, as well as what central banks are doing?
So no, you might be surprised to know we're still fairly constructive. We think the basic preconditions remain in place: very low interest rates and an ongoing recovery. Recovery fuels profit growth, and the interest rates mean the alternative for investing in growth assets is very hard to find. So there are more headwinds appearing. So at the margin, it's getting more difficult. And you identified a few of those, like the central banks are pivoting to removing stimulus, which will make it less easy than what it was in the previous year. So we can't expect returns to be as good as what they were. But it's not big enough a change to make us become negative.
What about what's become more attractive then? If you're sort of tweaking your portfolio around the edges at this point, where do you see the most attractive opportunities? Where are you perhaps de-risking a bit?
So the most attractive opportunities we think are in two areas: high quality unlisted assets, where we can get good long-term returns out of those. And so we've been deploying capital in those areas. And the other one, I still think that equities are reasonably attractive, at least for a few more years in the current environment. We still wouldn't deploy any capital into fixed interest yet. That cycle's got a bit further to go. And credit and those style investments are still very expensive. The returns are probably aren't high enough for what we're after. So the basics of a good equity portfolio and high quality unlisted assets remains the same.
So I think you were at something like close to 60% heavyweight allocation to equities. Do you see that staying pretty much the same, increase, decrease a bit?
We're probably a little bit under that, but not much. And over the next 3 years or so, we anticipate that weighting will come down. So it's certainly our intention to take some equities out of the portfolio over the next period, but we wouldn't be starting now.
Bonds have yielded so little. I mean, that's just a fact. We've seen a lot of interesting variations on how you then hedge volatility, and one of them has been more interest in FX trades. Can you kind of explain the attractiveness of that? Is that something that you've considered, and how would you kind of try and get that hedging effect?
Yeah, very good question. Really, it's like a pension plan expert. So the key thing with hedging is most of your portfolio is invested in growth assets, in equities. So what you want is investments which go up when equities go down. I know it sounds very simple. So the idea of investing in bonds is in a recession, you make capital returns on your bonds, and they'll compensate somewhat for the negative losses you make on your equities as earnings trump. The Australian dollar is also another investment which typically tends to go up in value, i.e. the $8, foreign currency goes up in value against the $8 in an economic downturn. I think a lot of plans will move to hold more foreign currency and a little bit less fixed interest over time and seek to, if you like, diversify their diversifiers over the next 5 years or so.
So does that mean you see FX exposure potentially for a long-term investor as a defensive asset class?
I think that's where it's going to head to.
What would you then need to see at a point where you start reducing that underweight compared to bonds?
We would think you'd need to have a long-run position in FX to hedge out the volatility. And you, at the margin, you might swap some of your bond exposure for more FX exposure. But the two risks aren't the same. That's why I like the idea of having a basket of diversifiers rather than relying extensively on one. If you go back and look at all the previous equity market downturns and see what happened to the Australian dollar or see what happened to interest rates, they don't diversify all the time. Sometimes you can lose money on bonds and equities at the same time. And sometimes you can lose money on FX and equities at the same time. But if you have a balance of both approaches, you'll be pretty well placed.
We touched on the volatility in China a little bit earlier, and I know Australian Super and a number of other pension funds have been steadily becoming more cautious on China, and that was even pre-Evergrande. Can you give us an assessment of I suppose, your strategy, if you will, when it comes to China, how much exposure you have and when you'd be more comfortable taking on more?
So we've had an office in Beijing since 2012, 2013. So I've had a long-term commitment to China, and we think it is an area of excellent investment opportunities, particularly as the capital markets become more accessible and more open. That has been our long-term view, and it's proven to be well placed. The changes in the Chinese regulatory environment around education companies, around the real estate sector and whatever, are to be expected to some extent as they put in stronger prudential requirements. So these things will happen in a developing country, but China still remains a very attractive place to invest. We've got about, I think it's $3 to $4 billion already in China. across listed stocks and some fixed income. And I suspect that's going to grow over time. China is the second biggest economy in the world and will probably be the second biggest location for investing in the world. I don't think funds can disengage from China, and Australia's had pretty close relationship with China over the long term. So I think all those factors will work in the long run.
So it sounds like you're comfortable with the level of de-risking that's already taken place, regardless of what happens with Evergrande and the property sector. What would you need to see to make getting more exposure a compelling option?
I think there's two aspects. You have a look at the stocks themselves, and we've got exposure to Alibaba and Tencent and whatever, and the regulatory environment around those stocks has been changing for probably the past 4 years, I'd say, progressively been changing for the past 4 years. Clarity around the regulatory environment would be useful for us to buy greater exposure, because then we'd be certain about future earning streams. The real estate, deleveraging the real estate is not a new story in China. China, on the one hand, we have people saying China's got a debt bubble, and on the other hand, we say deleveraging is a problem. We can't have our cake and eat it too. And what they've got is a process of steadily managing that amount of leverage in the economy, and that's probably pretty appropriate. So I think that all those conditions will sort themselves out over time, and we'll look for good long-term investment opportunities because we're a long-term investor.
Deal making has been thriving in Australia. You guys now are one of the first phone calls that investment bankers make when there's a deal on foot.
Investment bankers, the key thing for them is to get the deal done. And Australian Super, being such a strongly growing fund, has a lot of capital to deploy in unlisted transactions. So if I was an investment banker, I'll be calling someone with deep pockets, which is Australian Super. So that's entirely appropriate. The key thing is not whether we get the call, which we do get, but the key thing is really what is the quality of the investment opportunity. It'd be great if the investment bankers only rung us and nobody else, but they'll keep on ringing after they've rung Australian Super, and there is competition for assets. And in the end, we have to pay the market price to get them. So I bought a number of assets in the most recent 12 months, and more bank property logistics exposure. We were with Transurban in the WestConnect syndicate, and we've been in the Optus Tower sell down as well. All of those are really good long-term unlisted assets reflecting our strategy.
What else are you looking at, given that there are expectations that this is really just a sign of things to come?
Well, in Australia, it's pretty much opportunistic. You can't create deal flow. The deal flow has to be there. Then you have to be in the right position to win it if that's what you want to pay. So for unlisted assets, you're buying long-term earning streams. And clearly what we want to do is buy those with favourable tailwinds. So you've seen a situation whereby digital has disrupted a number of unlisted assets like real estate, for example, and benefited some others with regard to, if you like, industrial digital platforms and the like. So we're looking for more digital assets if we can. We're looking for those which have got really good long-term earning streams, and toll roads are an example of that. And then we're participating in the bid for Sydney Airport because we think the airline travel will come back as well in the long run. So favourable tailwinds, opportunistic investments which reflect market conditions, but all of that is really driven by the quality of the deal flow, which really is something we can't control.
Sydney Airport is an interesting one because you take a look at just how beaten down that entire industry has been over the past couple of years. Is this really backing an expectation that there are going to be some industries that not just recover from the pandemic, but actually come back stronger in terms of demand?
Well, I can't talk too much about the Sydney Airport deal because it's a public to private transaction. So I think I'll leave what I've said there. But we're favourable about airlines airports as long-term investments.
When it comes to the great debate about inflation, the market seemed to be considering this idea that it's going to be transitory for longer or perhaps even prolonged. And I guess if you're a bear, you'd be arguing that, as economic growth projections come down, we could potentially be looking at stagflationary conditions. Is that something that worries you? And do you have settings in your investments that hedge for inflation and also potentially stagflation?
Gosh, I grew up learning my economics in the late 1970s, and I thought I'd never hear stagflation again. And here we are, twice in a lifetime, it's come back to haunt me. Everybody in the market thinks the inflation is temporary. Make no bones about it, that's what everybody thinks. And if you have a look at the factors which have caused inflation to rise, it's heavily concentrated in those areas where there's supply chain disruption, and motor vehicle prices are singularly the biggest component of that in the US. Other things being equal, you would think that those supply chain dislocations would sort themselves out over time, and it wouldn't be a source of ongoing inflation. So I, like the market, are of the view that it's temporary, but it might take longer to work through because these supply chain disruptions are taking longer to work through as the recovery from COVID is taking longer. So all those things are linked up. COVID, supply chain disruptions feeding into higher inflation. Now, anybody knows that when you're an investor, you might have your base view, but you've also got to look at the alternatives, which is what you're talking about. What happens if you're wrong? It's very hard to protect portfolios from inflation. That's the bottom line of this. It's very hard. There's some assets which have CPI-linked revenue streams, which will help a long way, but not that many in your thing. And what you tend to find is that if inflation becomes persistent, interest rates rise, and that higher discount rate affects almost all assets. That's not our core view. But what you have seen is that central banks are moving to withdraw stimulus from COVID. That's entirely related to COVID, I think, and less related to the temporary nature of inflation.
I'm Kaylee Lyons from Bloomberg Television in New York, and I'm joined in conversation by Omar Aguilar. He is Schwab Asset Management Chief Investment Officer and Managing Director. So, Omar, we're going to focus a lot on the retail trader in our conversation, but first I just want to get your macro outlook. How bullish are you going into year end and on into 2022?
Well, this is very interesting, Kaylee, because we have gone into the fastest economic cycle in our lifetimes. At the end of 2019, we were in that process of, trying to decelerate. And obviously, nobody expected that we will actually hit a big pandemic that took the economy into a recession. And then we recover, quickly, very, very quickly. In fact, a lot of the economists, a lot of studies suggest that these ended up being more like a natural disaster where, tons of liquidity, stimulus program, fiscal programs, everything was attacking to try to solve the source of the issue, which in this case was a health crisis. And we did recover very quickly. And obviously the equity markets and all risky assets, took a significant amount of the lead on trying to get the economy back into shape. And so we're in that process where, going into the summer of 2021, we were really just, hitting in all those strides. Economic growth was very strong. We saw equity markets doing very well, corporations, having plenty of liquidity, record earnings, right onset of all these different pieces until we started to hear about concerns about supply disruptions, where we ended up having these imbalances, between supply and demand, when we had ports that couldn't get the capacity to deal with all the goods that were coming, and the demand was just in there. So we combined that with the fact that we had the Delta in the middle of it, put us into a place where we are, going into the fourth quarter, is still growing at a very decent pace, but I will probably say in one word, decelerating. We're decelerating the global economy. We're decelerating the rate of inflation. We're decelerating the amount of consumer demand, which is probably the main concern I have, going into the holiday season. And we're decelerating, all going into the end of the fourth quarter, which obviously puts us in a place where we're still in the recovery period. We're just not going at the same pace that we were, right at the beginning of 2021.
Yeah, so I'm wondering if that means that you think the buying of the dip, that behavior we have seen so frequently over the last 18 months, is going to stop working.
Well, we have recently done a lot of the work on behavioral finance, and it's something that we do at Schwab a lot to just educate investors on trying to take the emotions out of the market and focus on the long term. We just went through a month where we had a significant negative return in the market, which is something that investors have not been used to, at least for the last several months since March of 2020. So when that happens, that mentality of buying the dip, gets into, is it good time for us to just repurpose, those assets to rebalance? And there is a temptation to time the market. This is a great opportunity to get in. This is a good opportunity because things are actually cheaper than they were, 5% ago. And I know our process in educating clients, always is that timing the market is very difficult. You always try to think about your long-term goals and try to do these weighted dollar average where, it's not necessarily right a good time. Tomorrow there will be another opportunity. It is better to actually find those assets that you want to buy and have a strategy that allows you to systematically get into them.
Well, Omar, this is where the retail investor part of this conversation comes in, because it has been the retail trader that has driven so much of that dip buying. Is there signs that retail behavior is changing, that their desire to take on risk is waning the farther we get out from post-pandemic fear?
Well, it's kind of interesting. We are very happy and very proud to see that there is even more and more interest by the retail investors to get into the markets. It is always good to have more investors, thinking about how they can invest their assets for the long run. You're right. And if you think about, what has transpired in the pandemic, there was an excess level of savings that were accumulating during the process of 2020. In fact, studies and research shows that it was probably 4 times more excess capacity than in a normal cycle. So what that means is that there is a lot of savings. The consumers and the investors deleveraged. They reduced the amount of debt with the amount they saved during the period of 2020. And therefore, they have more time sitting in their homes. They have more time looking at the screens. They have more time. And therefore, their ability to actually start to get in and use those excess savings for investing was something that was very tempting. And in fact, they did. You're very right. Investors that started in 2020, were more interested in taking positions, in things that they had never done before. Now, what is interesting over the course of the last few months, Kaylee, is that has decelerated too. The deceleration of interest in what was so-called the meme stocks, started to just change right, at the end of the summer, not at the same pace that was at the beginning of this year.
Yeah, well, Omar, to your point, you talk about kind of the liquidity that has been out there for the last 18 months. You have the monetary policy side, but also the fiscal side, and the fact that stimulus checks put a lot more money in people's pockets. As those impulses fade, how does that affect how retail investors are going to be involved in the market going forward? Well,
the majority of investors that actually have gone into the market have actually seen positive rewards. The fact that you have still a bull market despite, the last, set of volatile days is that, you can actually see that reward goes into it. There is a very typical behavioral bias called recency biases that basically puts a lot of weight in your recent experience and recent information. And therefore, a lot of those retail investors, the new to invest, that ended up, investing in certain assets, they actually got rewarded. And therefore, that becomes in a snowball effect. They will continue to just go into that process. Now, what is interesting, though, is, and this is a big part of what here at Schwab we try to do, is we're very interested in continue to educate clients to know whether or not it's an actual investment that will work for their risk profile and for their wealth planning. And that's a big part of, what we try to do, because, the excess savings could easily go away if they actually don't get channeled to the right place. What is good about the studies that we have shown with the new investors, especially for those new to invest retail investors that are all kinds of ages, is that over 90% of those investors said that they actually want to learn more about investing after their first experience. So if you think about it, new investor that came in, started to invest in a meme stocks or in a SPAC or in any other areas, got rewarded. Now they got engaged, and all of a sudden they want to get more tools and research. And that's basically very good for the market, and it's very good for the investor in general.
So tell me how you go about that education, because talking about the meme stock phenomenon, one of those things that inspired was greater scrutiny from regulators and from lawmakers who want to protect the quote unquote uneducated investor and make sure that they are able and enabled to make smart investment decisions. How do you at Schwab make sure that they have the information that they need?
Well, we provide a lot of information to clients and research, and we always encourage to talk to advisors. The main component of what we try to do with retail investors, whether it's a do-it-yourself or whether it's somebody that seeks advice, is basically putting together, a component that allows them to exploit, what are the options that they have. A big part of that is understanding their own risk profiles. In other words, trying to understand what is that you're actually going to use those investments for. And that is probably the most important piece of it. What is interesting about the studies that we have done with retail investors, especially for those new to investing, is that the majority of people that try to get into investing, they're actually thinking about the long run. They don't necessarily execute in that way, but they actually care about the long run. They actually care about saving for retirement. They actually care about saving for generating income in the future. But what they're trying to do is trying to figure out what is the best way to do it. And, providing, research information, access to a financial consultant, access to digital tools, and that's probably key, of understanding how those digital tools can drive them so that they can actually get to the right investors. Asking the right questions through those digital tools is a key part of, what we do at Schwab to continue to, guide those investors to the right, place, to the right profile.
And this is all part of that kind of democratization of finance conversation. The fact that retail traders just have a lot easier access to the financial markets now than they did, say, a decade ago. Are there inherent dangers, though, that come with that?
Well, it goes back to the behavioral aspect of the market. If you actually think it's actually very good for people to be invested, that's for sure. There's no question about it. And the more people that get invested, the better we all are as a society. Now, you're completely right. The access to information, even for professional investors, is actually overwhelming. You can actually have information through social media. You can get information through different tools, your computer, your smartphone. And what that does, it triggers those behavioral reactions that you have to information. The most difficult part and the most prevalent thing that investors have today is the anxiety that comes from not knowing what to do with all that information. If you actually think about, all of a sudden you have an investment, you have earnings release, you have economic release, you have access to everything that in the past was probably not as simple to get. So what we have seen normally is that you actually have two types of behaviors. One is when you actually see market volatility, there is an emotional reaction that tends to drive a lot of the questions that we get. If you think about information that you get, inflation, hits, all of a sudden the market volatility goes in. People talk about, potential issues with regulation around, certain areas of certain stocks immediately there. The FANG stocks was another one that we have seen recently. And then going into that piece, the information that gets you, a lot of what we have to do is continue to educate, of not necessarily overreact to every piece of information. Reduce the amount of consumption of everything that comes in and focus on that long-term plan. And that's the reason we encourage every single of our clients to try to come up with a financial plan that allows them to have those so that they can mitigate those over and under reactions that they have to information.
Yeah, so talking about the Schwab-specific angle, how have you had to evolve to meet this moment of easy, accessible markets and information? What changes have you had to make to the products and services that you offer?
Well, it's a very interesting. We believe that the world, continues to be rewarding digitalization and personalization. Those are the two words that we continue to give to access. Schwab has always provided options for investors. We are, trying to lower the cost and trying to give access to everybody that wants to be invested in the market. But as such, we also believe that investors continue to actually, put money to work with their values. The concept of personalization is something that continues to evolve. If you think about the evolution of the phone, when you actually, had way back in the way, just, landlines, all the way through smartphones that you can create, you put your pictures, you can put your, little, pieces in there that becomes yours, the world of investing has actually evolved to that area. Now, that is not something completely new, but it was only available for ultra high net worth and high net worth investors for a big fee. What Schwab is actually doing now is in the process of creating more tools to give access to investors so that they can actually have access to tax management, to can have access to, ESG investing. They can have access to different set of low cost, index and ETFs so that they can actually create their plan and they can actually figure out what is good for them. But that concept of personalization where you can be investing and at the same time follow your values, think about what you want to have, mission, is a big part of the driver of what the future might look like.
How have you seen the values that your clients would like to focus on change over time? Is it now more leaning toward ESG or is it something else?
Well, there's all varieties, and that's what makes the markets rich. Not everybody necessarily has migrated towards believing that ESG provides a big value in terms of performance or in terms of return or in terms of value for their equities. That's something that investors have a preference there, but there is a significant increase in interest in understanding how the ESG, environment evolves over time. Not everybody, believes that ESG is the same for everybody. It goes back to my comment of personalization. For you, the environment may be more important than social events. For me, social may be more important than some quality or governance issues. So all of a sudden, the concept of how people apply their views on ESG is not a one-size-fits-all. It basically has to do with how investors put those money to work where they believe, trade-off between their value of their equity and their investments together with what their mission and their values are. And that is the reason why digital tools and customization become so relevant for the next generation of investors.
It all comes down to personalization. Omar, thank you so much. It was great speaking with you. That's Omar Aguilar, the Chief Investment Officer of Schwab Asset Management. And Bloomberg Invest Global continues. Please stay with us. All you have to do is return to the main online summit agenda to access the next session. Thank you, and stay tuned for more Bloomberg Invest Global.
Years into the pandemic, a global recovery is underway. Global vaccination rates are improving, and the world is adjusting to a new normal. Yet, the markets remain volatile.
Beijing's crackdown continues. Chinese stocks listed in the U.S. suffering.
The global supply chain is in turmoil. The Fed is rolling out massive stimulus.
We will continue to provide the economy the support that it needs for as long as it takes.
Could soaring debt trigger the next financial crisis? How can investors navigate volatility and uncertainty? Amid the volatility, where is the opportunity? We put this question to the biggest names across finance and economics. This is Bloomberg Invest Global.
Hello and welcome to Bloomberg Invest Global. I'm Ed Hammond, the deals reporter here at Bloomberg News. If you've just joined us, welcome. If you're with us for the previous hour or even the previous 2 days, we're delighted to have you back again. We have an amazing lineup of speakers and conversations that we're going to get going on in just a minute. But before then, remember that we want you, the audience in this event, to participate. So engage with us via social media and via chat. The hashtag is Bloomberg Invest. Let's get started. Next, my conversation with Orlando Bravo, founder and managing partner at Thoma Bravo. Orlando Bravo, great to be with you. Great to have you on this morning. You're joining us, I know, from Miami.
Ed, thank you for having me. It's good to see you. You're looking great as always, by the way.
Well, thank you. I think the New York weather is doing me some favors by giving me a sort of gray backdrop against my nice blue. So look, let's start with Miami. I took the liberty of going on your Twitter feed this morning. One of your most recent tweets from a couple of days ago says, "Miami, it's the place to be!" exclamation mark. What is it about Silicon Valley that's become unappealing in the last year or two?
Well, look, for us, we love Silicon Valley. We still do. We are growing, so our San Francisco office is a lot larger today than it was 2 years ago. Now, we also love Miami. How could you not love the movement that's going here? A new tech hub is being created. People can be really entrepreneurial, and it gives a big opportunity for young future leaders to set their own mark, also in a society in a way that fits them. They can do philanthropy in their own way. They can be leaders in the community. It's a lot more open to these young, talented adults, especially in tech.
And on tech, you and I have talked a lot in the past few years about valuations, and they seem to be getting higher and higher and higher without sort of ever slowing down to catch breath. I wonder how, as a private equity firm, therefore, what we traditionally think of as buying sort of cheap and turning stuff around and putting it back out, how do you manage in that environment?
There is no such thing as cheap anymore. There were only 2 times in our history, in our 22-year history of doing software buyouts and software investing, that in hindsight only, it was cheap. That was 2000 and 2001, after the first internet bubble burst. And then maybe a year and a half during the financial crisis, when it was still really hard to do deals because nobody wanted to sell companies. We were able to transact with a lot of public companies at that time, which we were fortunate to do. But really, especially software buyouts, it's really a growth industry. It's really a growth equity industry. It's a growth buyout industry. So you have to pay up to buy the best. And then not only that, you have to then provide big operational and value added to these companies in order to make the acceptable returns that our limited partner community needs for their business.
And let's talk about that, because when you say pay up by the best, at the moment, at least, that means writing very big dollar checks, and therefore you have to go out and raise very big pools of capital. You guys, I think last year, closed your most recent fund at around $23 billion. You're out raising a new fund at the moment. How does that work when you are a smaller or newer private equity firm coming into the market? You can't afford to write these checks, and even if you can, you don't necessarily have the operational experience needed to turn these companies from, you know, expensive, decent companies into even more expensive, very decent companies.
So that's a really insightful set of points that you're making. And look, there are 3 significant barriers to entry now in tech buyouts and in software buyouts in particular. Number 1 is culture. A new entrant, you know, culture is becoming the differentiator. As I like to say, culture is not the most important thing for us, it's the only thing. So as a new entrant, how do you set yourself up to fit what is going on in the market and in the companies that you're trying to buy? That's a big deal, because now this is an established place. It's not a new industry to do software buyouts in. That was 22 years ago. The second big thing is operational expertise. The average publicly traded SaaS software company today, the average one, loses money. And these are the best. So you have to have a set of skills and a history and a reputation for bringing these companies to 30 to 40 to 50% EBITDA margins in order to do the fundamental investing that our industry does. Those are 2 key ones. The third one is newer, and it's scale. It is very important to us to buy the number 1 player in each specific software market. You look at our deal with Proofpoint, a $12 billion deal. They're the number 1 email security vendor in the world. Why would a customer waste their time to invest or buy the product of the number 2, 3, 4, 5, 6 email security vendor when email is the main threat vector of companies? We're seeing customers then behave that way and going to the best of breed very quickly. Now, those best of breed players and those market leaders that we feel is where the world is going, those are now massive companies. So it requires big equity checks, and they're compounding at 20%. And that in itself is another big barrier to entry.
And we're seeing that not just in tech, obviously, but across really all of private equity, in terms of the very, very large private equity players seemingly inexhaustive ability to go out and raise huge amounts of capital to write very big checks. I wonder, is there a case, or are we perhaps approaching an era when there is a case for there to be more regulation of the space that you would see in traditional corporates, you know, whether that's looking at their deals on a sort of antitrust basis, or indeed looking at a possible breakup scenario for some of these firms that just have too much power, too much concentration, and therefore are keeping other entrants out of the sponsor space?
That's absolutely the case. I mean, you're seeing big monopolies being built or establishing themselves even deeper in some of these markets. We do business-to-business software. We don't do social media. We don't do consumer. In general, in business-to-business software, most of these markets are heavily fragmented. Now, there are cases of companies that I won't mention their names that have monopoly positions because they give out all their other products for free in order to support something else. And that stifles innovation, because if you want to start a software company as a best-of-breed vendor and you face a free, lesser company in the market, it's kind of difficult to operate in. But in general, for us, when we look to sell a company, many of the new buyers of these large software assets are industrial companies that are looking to digitally transform their businesses, not only internally, but through M&A. And they need scale, and they don't have antitrust issues because they're not in the space yet. And that's a very attractive strategic buyer for us.
Thinking of regulation, another area that is obviously very hot at the moment is the SEC and their proposals or initial proposals to allow retail investors more access to private equity. It's been a topic discussed for years, this sort of how do you connect this mass affluence with private equity. They're keen to let it happen, but they said there needs to be better regulation, obviously better transparency about what retail investors are getting into. From where you sit, what should that look like?
Disclosure. Go back to the philosophy of the regulation, of the regulatory scheme that exists, and just provide more disclosure. Have the managers that are out there raising capital for retail investors provide all their numbers in many different ways, and just have proper disclosure, because I do believe, and we were talking about it before, that retail investors, the retail investor of today, is totally different than the retail investor of 20, 30 years ago. These are extremely smart, highly educated, talented, in many cases young adults, and they want in the game. And if you don't provide access to private equity and venture capital for these great retail investors, they will find it in other ways in the public markets that regulators don't like either, like SPACs or other quote-unquote high-risk areas.
Well, then flip that round. Is the government doing too much to sort of mollycoddle retail investors and hold their hands, and therefore not giving them credit for what you say is that level of sophistication that's there?
I think the regulators are not giving the retail investor the credit they deserve for their sophistication. If you look at some of the strategies that have been used by retail investors, those could have been used by the big money managers, and they didn't. They have been innovators in the space in many ways. Once again, the profile of the retail investor is totally different than it was 30, 40 years ago. When I started working in 1992, what you were worried about in terms of the retail investor was somebody that looked like the Wolf of Wall Street, calling my grandmother and selling her some pink sheet stocks that you couldn't even find in the Wall Street Journal. This is a totally different set of information, totally different people, and they want in the game.
And how much do you think that's to do with the way social media and the way that sort of modern technology has actually allowed them to mobilize to do things like we saw earlier this year when the shorts were being sort of squeezed in a way that was not necessarily coordinated, but certainly carefully, it seemed like it was carefully orchestrated through social media platforms?
Completely. How powerful that has been. I follow some of these retail investors for fun, first, in social media, and two, I get some great insights from them. And the fact that the power of this distributed computing world, and the fact that they can reach a lot of people just so quickly and get a big following for making good investment decisions, that's a big deal, and that's a big change.
Tell me, have you had any ideas from them that have led or will soon lead to a buyout by Thoma Bravo?
Well, not that much. Not, no, it's not that big yet, but certainly for my own individual investing, I get some ideas. And also for some of our public holdings, you get to see how the actual investor publicly out there gets to think about valuations and growth rates. And I think that's insightful.
I saw recently, obviously, your comments on Bitcoin. You've been very publicly bullish about it and about, indeed, crypto in general as being sort of future of currency. Talk to me about how we might see that intersect with your sort of business, your day-to-day business. I mean, is Thoma Bravo going to invest in the space directly? Are they going to allow LPs to give them money in the form of cryptocurrencies? How is it going to work from a business standpoint?
Well, look, first of all, we were one of the lead investors in the growth equity round of FTX, which is just a phenomenal trading platform. We believe it's the best in the market. We we will be big players on the buyout side as this industry matures, especially around blockchain technology. In many cases, blockchain provides better use cases for problems that exist than database software products. And we are seeing this maturation, and we will be participating in it in a big way. To us, it's just the software market or the digital market just became a lot bigger, and it's providing a bigger opportunity set for us.
What does it look like in terms of the deals we could see you do? Are the companies that you would obviously go after for buyouts in the space, or is this going to be more like a venture capital model?
First, it's growth equity. That's where the market is for this category. And now late-stage growth equity for this category is becoming very feasible to invest in. I think in the next 2 to 5 years, it will move to rate control transactions, and we'll be right there just like we were 22 years ago as one of the first software buyout firms in the world.
Another area you and I have discussed is SPACs. Obviously, you did the Thoma Bravo Advantage SPAC earlier this year. It's now de-SPACed through IronSource, which is now trading as a public company. The SPAC game has been somewhat sullied, I suppose, by abuse by some participants, or perhaps like too much energy too quickly going into the space. I know when we've talked about it before, you said you had hoped to do another SPAC. Is that still something that's in the works?
Yes, we will do now. Nobody likes that word. Nobody likes that term. The regulators don't like it. Now investors don't like it. So we for sure will call it something different because it will be something different. I mean, we do believe that there should be great alignment between the SPAC sponsor and the investors, just like there is in private equity. Investing real capital behind it, being the lead investor in the PIPE, for example, which is something that we did in our deal with IronSource. We believe there should be a lot more transparency in terms of what are the returns of that SPAC sponsor, what do they look like, and there should be a lot more transparency in terms of how does that company perform versus the projections that they originally gave the investors. That should be disclosed in every quarter, and that should be a requirement. So we feel that SPACs are one of the great financial vehicles for absorbing this wave of large software companies and tech innovators that are looking for alternative forms of financing. Now, it's also a great vehicle to combine the best of the liquidity in the public markets, the diversity of investors that you get in that process, and the best of private equity as well. And we believe we have a model for that.
But when you look at it, yes, a lot of the SPAC deals that were done did involve those kind of companies, but an awful lot also involved the kind of companies that were highly speculative, had sort of predictions that potentially will be met, but they were fairly ambitious, I think, to put it lightly. Is that going to make it difficult to go and do a SPAC in future, because people are going to look at it and say, well, you know, we don't believe the predictions, because the last time this was going around, people were saying it was going to achieve X, Y, and Z, and none of it was delivered?
Look, the SPAC is about who the investor is, who the sponsor is. That's hopefully also helping the company operationally, and it's a good partner. And the SPAC is about the company. That's what it's about. It's like an IPO. Would an investor value a company differently because it went public with this set of banks instead of with this other set of banks, or because it did a direct listing instead of not a direct listing? That's irrelevant. It's about the fundamentals of the company. Now, I do agree with you that the SPAC market shouldn't be for venture deals, because one of the advantages of the SPAC is that you can project your business, and projecting a venture company, no matter how good you are, is very difficult, because you have no track record and history at that company of producing results and seeing where you're going to be in the future. Now, of course, venture companies go public through SPACs because there's the demand from retail investors and others that cannot access the venture capital industry anyway.
And I suppose that you need that narrative, which a lot of those companies seem to have, to get the sort of early excitement. Let's just talk about IPOs before we wrap up. Obviously, we're seeing some of the other large private equity firms make their sort of steps towards going public. I think TPG is widely touted to be the next one out. What can we expect from Thoma Bravo in that regard in future, in terms of, you know, public company versus private company?
We love our private company status. We are one of the few large private equity firms that's 100% employee owned, and we like it that way. It provides great alignment between us and our limited partners. And that is the fabric of how we built our business over time. And going back to culture, culture is not the most important thing for us. It's the only thing. And our ownership structure allows for that culture of providing and promoting the next generation of future leaders. That is really what drives us.
But couldn't you maintain that and keep the culture within the firm whilst being a public company, whilst having, that public equity, which potentially would be good for the culture and good for the partners?
You could. I think you make a really good point. You could. The way we think about these decisions is decisions that are reversible, we make very quickly, because if we make a mistake, we can adjust. Decisions that are irreversible or may take a long time to reverse, we really take our time and are very thoughtful about it, and that's how we're dealing with this staying private versus going public point of view.
And let's just end where we began in Miami. You are opening this new office very soon, I believe, in Miami. Is the plan over time to migrate more and more of the company to Florida, or do you think San Francisco is going to remain the home base?
San Francisco is growing. We're growing. San Francisco is growing a lot. We really love it there. And we also love Miami because going back to culture, it was very important for us that we continue to hire diversity of thought and diversity of talent. Having an East Coast office, especially in this new growing and exciting tech hub, is adding to our culture significantly. We've been able to hire some great people, and we've been able to really promote, once again, future generation leaders and now can lead in different ways.
Orlando Bravo, great to have you on the East Coast. Always lovely to get your thoughts and your wisdom. Thank you so much for joining us for this conference, and speak again soon.
Thanks so much. Good to see you, Ed.
Digital currencies are reshaping the investment landscape, and so are we. As the world's first and largest digital currency asset manager, Grayscale is the investment partner of choice for individuals and institutions. Go digital. Go Grayscale.
Well, hello there. I'm Haslinda. I'm an anchor of Bloomberg Television. There is a funding frenzy in Asia. Global investors are rushing in to make a bet on Asian tech startups as the pandemic has accelerated digital adoption. Southeast Asia will have 350 million digital consumers by year's end. India already has 500 million, and it's working on the next 500 million. Let's talk tech. Sheila Patel is vice chair of B Capital, VC founded by Facebook's Eduardo Severin. Sheila, good to have you with us.
Great to see you again, Haslinda.
It's been a while. Sheila, the last two decades have been about consumer internet. The next 2 decades will be about digital transformation of traditional industries. Where are you seeing the biggest opportunities in Asia in the year ahead?
Well, I think the opportunities in Asia are just spectacular, and it's certainly a focus. It's been very exciting for me to make the shift into venture, and particularly, as you mentioned, with B Capital after years in large-scale asset management. And as we look at technology in Asia, I think what you're seeing is what you mentioned at the header, the digitization of huge portions of the population. In 2010, only 2% of Indians had a mobile phone. Today, as you mentioned, over 500 million. But what does that mean? Particularly pandemic-driven activity has just been amazing. So people are shopping online. They're using their phones for finance. FinTech is having an explosion in Asia. And what we see in Southeast Asia and Indonesia and India is innovative new companies that are coming up with new ways for people to use these tools. When you think about comparing East and West or whatever comparison or buckets we want to make between emerging and developing markets and what we call the developed markets. When it comes to technology, I'm not sure those monikers actually fit because some of the most interesting developments in technology are actually coming from places like China, India, Indonesia, Southeast Asia.
That's right. I mean, we hear people say that when it comes to fintech innovation, Asia surpasses that of the Valley. What innovation are you seeing in Asia that you're not seeing in the Valley?
Well, one interesting example is the all-inclusive nature of fintech that you see in Asia. So in many cases, someone is able to do multiple things with an app on their phone. In the US or in Europe, you've tended to see very tight verticals of development in some of these technologies. Something is checking and bill payment only. It doesn't also have savings. You can't also use it when you go in a grocery store. And so you have a proliferation of apps. Whereas what you've seen in Asia, in many cases, is a all-encompassing ecosystem that keeps the person in the business more, and it keeps the person solving their everyday problems with one company rather than several. But particularly, if you think about some of the things going on in Asia, we also see a boom in services for small and medium enterprise. In fact, in the last few weeks, we've had fundings for several companies in the space. And so Book is a really interesting accounting services company for small and medium enterprises in India. It had a funding round, Series C, that was very successful. There's also Aspire right in your hometown in Singapore, which is a neobank for small and medium enterprises and helps them with their banking needs and their financing needs. So there really is a proliferation of very interesting business verticals in Asia that we see continuing to grow.
When you talk about tech, you have to talk about China tech. I mean, it's been under tremendous scrutiny, tremendous clampdown. And I know that B Capital is looking to allocate as much as 40% of its $2 billion global fund to China. I mean, how are you looking at the clampdown? How are you assessing it? And what's still looking attractive?
Sure. Well, I think when it comes to China, let's hit the macro and then go to the micro. On the macro side, investors got a surprise. I don't know that some of us in the market in China would necessarily characterize it as a surprise. From many different perspectives, if you look around the world, regulators have gotten their hands very dirty on data for consumers and on privacy. And as you think about GDPR in Europe, as you think about some of the data discussions going on in the US and elsewhere, you see that governments are very interested in knowing how data for their citizens is used, captured, reused, recirculated, and frankly profited from. And so when you get to China, it's no surprise, I guess, in our eyes, that you see the same thing happen. Now, how regulators can act in China, the government's ability to act very quickly versus some of the signaling that investors are used to in other markets. This is where China is a different market and where it pays to have a lot of knowledge about what is going on and how people on the ground are thinking about some of these changes. For us, as we look at China, the place we see really relatively unexplored and about to boom is enterprise, is digitization for business, things that grease the wheels of commerce, so to speak, that make businesses have an easier time. So let's move away from the consumer and let's think about where is the next Salesforce? Where is the next Oracle? Where is the next great innovation from an enterprise perspective that could come out of China? And from our eyes, China is a place ripe for that with the number of businesses that have grown over the last decade, but the fact that they don't necessarily have the digital support that could make their businesses even more efficient and profitable.
I'm just wondering if you can be confident about the winners. Are they clear winners even now, or do you want to wait for greater clarity before deciding where or how to deploy your capital?
Yeah, look, I think it's such an interesting market right now, and you see it in everything you look at and every conversation you have. There is money flowing into this space at a pace that's kind of astonishing when you look at it in some ways. And so entrepreneurs that might have been previously starved for capital now may have a menu to choose from. You know, for us, one of the things that helps us be selective, but also helps us be confident about the companies where we take on an investment and partner and look for them to grow is our partnership with BCG, which we think is very unique. So BCG, the global consultancy, has expertise in multiple sectors, has connectivity to some of the biggest companies in the world. And when we go in and look at a founder's ideas and business and how they look to grow, leaning into what we can bring them from that BCG perspective. Perhaps we can advise them on this sector and the ways it's been made more efficient in other countries and bring that BCG expertise to them and see them grow more rapidly because of that. In many cases, BCG's global network of large-scale multinational companies might tap into the expertise a company we've invested in has in a particular marketplace. So there's still value to be brought by the venture capitalists out there, by the investors out there. For us, BCG is a key part of that value add. And so we look holistically at where a company can go from a growth perspective, but we also think about how can we help them do it.
With China under scrutiny, is India looking even more attractive for VCs? I mean, it's a vibrant startup scene, more than 60 unicorns and counting.
Absolutely. So we see some major opportunities in India. We kicked off our discussion with the digitization there, and I think that can't be overstated. If you have 500 million people on their having a mobile phone, and mobile phones are getting cheaper, and the service is getting cheaper as well, you not only have that base that's one of the biggest in the world, but according to App Annie and some other research on how Indians are using their phones, Indians are the top three users of their devices. And so that has opened a broad spectrum of areas where we can see activity. For example, online commerce, social e-commerce. Mishu is a company in India in which we've invested, which just did a new round. And they've seen their business skyrocket. Mainly it's because you're seeing Indians adopt that technology. But what do we see that's different? As we expand and grow and see these businesses burgeon in India, you're seeing Indians use their technology in a different way. There are massive cities to navigate. There are shops and small businesses that are using chains of value that are actually disruptive to value because it is so many middlemen for them to get to the next place. We're seeing India becoming a real harbinger of the disruption to come in how goods get to consumers and how they're able to access the most interesting products from their country or region in a very efficient way.
Is there reason to be concerned about regulations, about the government possibly turning back policies?
Look, I think in every market, we pay close attention to regulators and regulation. I think, again, some of the things that have come up in every market that you will see continue are how are you treating consumers? What data are you taking from them? Are you deviating from any norms? I think fintech is actually a place where having that combination of innovation and thinking broadly about what financial services would make businesses better, not just individuals' lives, but again, the wheels of e-commerce work better is critical. But then thinking about what fits within the constraints of regulations, or in fact, what regulators might even welcome. And I think very much in spaces like fintech, we haven't really talked about healthcare, but healthcare is a place where we see huge opportunity around the world and great ideas coming out of Asia. These are spaces where you have to think about the partnership and the vision of where a regulator sees a marketplace and make sure you're acting accordingly.
Earlier, I talked about how there's so much capital looking for all these investments, and that takes me to a question from the audience. Rob is asking, how do you hedge against overpaying in these growth markets or in these companies?
Well, it's tough markets to do that, right? I think it's gotten harder. Because you're seeing many new entrants, you're seeing many people that are deploying capital for the first time. We really take a step back. We try to make sure that we are picking companies and ideas and partnering with founders that we think not only have a grasp on the marketplace they're in today, but have the potential for a footprint beyond their current scope. That's a place we can really tap into BCG, where their perspective on how things have gone in other marketplaces, on where certain technologies might be able to have leverage. This is a place where we can evaluate a company and do that valuation, really thinking about where they go next as opposed to where they are now.
I'm interested in getting your thoughts on the consolidation trend. We had Grab acquiring Uber, we had Gojek and Tokopedia in Indonesia emerging, valuing that entity at more than $18 billion. Will consolidation be a theme? Will consolidation accelerate? Will we see more M&As in the next 1 to 2 years?
I do think you'll continue to see consolidation and acquisitions. There are a few different paths for this. Some of it is combinations of like businesses. That's no surprise. Again, for efficiencies, for their own resourcing, it makes sense for some of these businesses to combine. But importantly, and this is for us a place we lean heavily into our BCG connection, there are global players and large regional players that find it hard to foster innovation internally. We all know that. That's tough. It's hard to change things or come up with a great idea in your own house. But when you hear how somebody else does something, you're like, why didn't I think of that? Why didn't I come up with that idea? And so, I think you see many, many large companies, or at least larger companies, that have tried to fix certain things in the past, that have tried to innovate in telemedicine, but they're already a mega scale provider of services. They've tried to innovate in fintech, but they're already a big bank and they have a way they do things. And it's hard to make people envision a new way. I think you'll see acquisitions in these sectors that we're focused on, enterprise, fintech, healthcare, because large scale players need great ideas and they need them now. They have a choice between being disrupted by the ideas or adopting them, and acquisitions are a great way for them to bring those ideas in-house and, frankly, to leverage those ideas to scale. And leveraging ideas to scale is, again, to answer Rob's question again earlier, leveraging ideas to scale is another way that you can take these companies and bring them to a place where you're comfortable on a valuation perspective.
Are you encouraging companies that you invest in to consolidate? That's one. And two, is there risk perhaps that merged entities will lead to markets controlled by few powerful players? And that takes us back to China. I mean, China's trying to control the big tech because it's gone too big. It's monopolistic. So are we going to be in danger of that?
Look, I think at the moment, from a broad brush, tech is so fragmented and ideas, disruption, and innovation are coming from so many sources. I think it'll take a while before you see that concentration come through the acquisitions we see going on. That said, we work closely with the companies in which we invest to think about whether acquisition is a path for them. It's not something we proactively seek out necessarily, but because we have this connectivity between the new scale space, the companies that are on the cutting edge of coming up with ideas, and the large scale companies that our partner BCG and we interact with every day, finding those moments when that partnership and that combination might make sense is a part of our DNA. And we'll keep thinking about that. Does that create a behemoth player? That would take a while, I think, in some of these spaces, but you never know. And certainly when it comes to China, I think we should be conscious, particularly for services for businesses and in areas like healthcare, that there could be the next great big idea that is large scale coming from that marketplace, however much it's been a place that's been disruptive or challenging for investors themselves of late.
Sheila Patel, B Capital, thank you so much for your time today. Been a pleasure.
It's great to see you again. Thanks so much.
Likewise.
look forward to continued growth through customer-centric initiatives driven by our inspired people and culture, providing products and services that are easy, safe, and valuable.
Hello, this is Diane Edwards from JAMPRO in Jamaica. We are Jamaica's economic development agency promoting investment into Jamaica and exports from Jamaica. Thanks for joining us for this special discussion on Jamaica's opportunities for investment and our rapidly growing financial sector. You're going to hear very shortly from Septimus Bob Blake, who is the CEO, the group CEO of National Commercial Bank, the largest financial institution in Jamaica. And in the meantime, I'm going to tell you a little bit about Jamaica's economic situation just to set the context for our conversation. So Jamaica pre-COVID was in a great place. We were on a growth path. We had actually reduced unemployment substantially. Our inflation rate was stable, and we had gone through 19 quarters of economic growth, positive growth. We were in a good place in terms of our trajectory and in terms of the international financial markets assessment of our creditworthiness. However, COVID hit, as we all know, and we're still living with it and will continue to live with it. So what did the government do? Take a number of initiatives really to drive us out of this COVID period into growth, back to growth, and recovering stronger than we were before. And what this has meant is innovation in a number of areas. This has meant upskilling our people through a global services sector project, which we implemented with the IDB, and also creating a number of strategies to improve our delivery and our ability to grow in certain critical sectors of the economy, such as global services, agribusiness, and manufacturing. We are really excited about the potential that Jamaica has going forward, because we see that in certain industries, we have been able to grow even despite the pandemic. I cite, for instance, outsourcing, where we have grown back to 43,000 people employed in this sector. We look at positive GDP growth. We look at the recovery of the tourism and hospitality sector, and we look at the growth of agribusiness, where we are really poised to improve our food security in agribusiness and also to make Jamaica a true export nation in agribusiness. And now I really have a treat in store for you, because you are going to hear from Septimus Bob Blake, and he prefers to be called Bob, so I'm going to call him Bob, who is really the driving force and the CEO and leader of National Commercial Bank, Jamaica's largest financial institution. So Bob, can you tell us a bit about NCB, the National Commercial Bank, and its role in Jamaica, and how some of your key success stories?
So the group on a whole, aids in accumulating capital, mobilizing savings, availing funds, which I'd say support the growth and economic development of individuals and corporates. And given the breadth of the NCB financial group, we can create end-to-end financing solutions across all the key sectors. So we see our role as one, primarily supporting the unlocking of capital, that is making funds available. We're rethinking currently, the risk-reward spectrum and ensuring we invest in capabilities to support those key segments. Another important area for us is that, we design and deploy innovative financial solutions to key growth sectors of the economy and where we see opportunities looming large. So we are bullish about the future. I think over the past 8 to 10 years, the financial system, has performed creditably. We came into the crisis in a strong position, both as a sovereign and also as a financial system. And we believe that we, though interrupted by the pandemic, we're looking at it in two frames. One, to ensure that we navigate the crisis, firstly, but secondly, making those bold moves which allow us to accelerate out of the crisis.
Fantastic, Bob. That sounds really great. What are some of the investment success stories for NCB in Jamaica? What would you want to tell our audience about those successes?
Well, we see opportunities across a number of key sectors. There's infrastructure, there's agriculture, there's manufacturing, there's tourism, and some other viable sectors. So as an example, we would have supported the Trans-Jamaica Highway, to raise both equity and debt financing to repay debt and fund future concession agreements. And between October 2019 to about March 2020, NCB Capital Markets, which is one of our key subsidiaries, was lead arranger for purely what I'd call highly subscribed and successful initial public offerings to the tune of in excess of about 129 billion Jamaican dollars. And we'll continue to play a part in that space. In terms of tourism, tourism sector is of critical importance to us and to Jamaica because it historically has accounted for about 1/3 of the economy. And there are challenges with the sector in 2020 brought on by the COVID-19 pandemic. But we responded primarily, to support that infrastructure, which would have been built up over decades. And our position was that we would respond in such a way that we would help many of our corporate customers to navigate the crisis, but also to put them in a position to accelerate out of the crisis. So we would have responded with, restructuring of transactions to facilitate the challenges that they were having with their cash flows. We'd have extended new facilities. And we also developed during that period through NCB Capital Markets creative solutions. One of the areas is, what we call TRIP, which provides tourism players with creative funding solutions needed for retooling and, more importantly, sustaining operations. We expect that this will, facilitate broader investment participation in this fund. It, on the one hand, deepens the asset pool available to investors, and also will assist in terms of their access to higher yielding investments. So that's one more area. In terms of commercial agriculture and agro-processing, there are significant growth opportunities in agriculture. And it may sound strange, I'm talking about agriculture, but the opportunities are probably twofold. One, import substitution, which represents a significant opportunity. The other opportunity is to, support domestic demand and to get us also into a net export position. And we continue to fund, through various offerings, whether through debt or equity, through the various vehicles of the NCB Financial Group. The global services sector, which you spoke about earlier, is an area which we have seen some amount of resilience through the crisis, and we have actually seen growth. I think Jamaica is ideally positioned as a near-shore location for the Caribbean, and it continues. That sector continues to fuel growth and job creation, and we have funded and continue to fund infrastructure in that particular area as well. So we have partnered in respect of access to that particular area whether through facilities with our Development Bank of Jamaica or with USAID as an example, to have access to lines which provide things like partial credit guarantees, and our interaction with this sector is beneficial to NCB over the long term, because as these companies grow, I believe there'll be more opportunities to create wealth and take advantage of investment opportunities.
We're going to have to wrap up now. So I just wanted to leave our audience with one final word, which is really great opportunity to partner with the National Commercial Bank in the future development of Jamaica. And if you want to find out more about them or us, the NCB website is jncb.com. The JAMPRO website is dobusinessjamaica.com. And our virtual investment conference website is explore.dobusinessjamaica.com.
It is a joy to be joined now by Managing Partner of SoftBank Group International, Nyatta, who, of course, joining me, Caroline Hyde of Bloomberg Television, to discuss a little bit more about your sort of wonderful marriage in where you are currently seeing investment opportunities, because you head up, you co-lead so many different funds over there, whether it be the Latin American funds, whether I think you've got in excess of $8 billion being put to work now, the Opportunity Fund, which invests in founders, entrepreneurs of color, and indeed, of course, the Miami-based startups that you've been looking to allocate about $100 million towards. All of these areas, you say, have a connection in that they've previously been underserved in terms of capital markets. Is it now really competitive? How do you thread that needle between all of them?
Sure. So some background is I've been investing for Masa and for SoftBank for almost 7 years. And the first period of that was global. We were investing in India and China and the US predominantly. And in late 2018, early 2019, Marcelo Claure, who was my boss, and I realized there's nobody from Latin America showing up in the hallowed halls of Tokyo to pitch their startup to Masa. Why is that happening? And we decided to take a look at the region, set up a fund focused on the region, and 2.5 years later, what we've realized is if you show up, they will come, so to speak. The entrepreneurs are there, the ecosystem is maturing, everybody understands how to build a startup now. All that we're missing was a committed capital partner for the long haul. And so that playbook of if you show up and you show commitment and you plant a flag, entrepreneurs will come out of the woodwork, has proven to be true in Latin America, is proving to be true with our Opportunity Fund, which, as you rightly said, is focused on founders of color in the US, is proving to be true in Miami. All these unexplored areas of startup activity, which are not on the commonly beaten path. And over the 2 years, many other investors now have flocked to Latin America, increasingly flocking to founders of color, increasingly flocking to Miami. So it seems we were right and we were early, which makes it difficult not to welcome the competition, because we like it when all these founders get capital, but at the same time, we don't like competition. So it's a conundrum. It's cognitive dissonance on that front.
So talk us through that cognitive dissonance. How do you see the competition coming and meet it head on? How do you distinguish yourself? How do you still make yourself the partner of choice, not just the first partner when it comes to, say, Latin America?
Yeah, it's important to build to last as a fund. We say this to startups all the time, but building to last is a concept we take to heart as a fund business too. So in Latin America, we planted a flag in the region. We have most of our people in Brazil and in Mexico and some in Miami. And in those Brazilian and Mexican offices, we're focused not just on capital, but also on how we help the companies once we fund them. And we're there to stay. A lot of the other investors who've come into Latin America are based in New York or based in Miami or based in Silicon Valley, and they fly in, they make some investments, and they fly out. We're in the region, we're hiring in the region, we're committed to staying there. I think that gives us a long-term advantage, both in terms of finding opportunities, getting positive selection, not just the companies that can raise in New York and San Francisco, but the good companies wherever they're able to raise, and also in adding value once we invest, because we're building a team to do just that. Same thing with the Opportunity Fund. We didn't just say, as many other firms had said, we care about diversity, we care about promoting more Black entrepreneurs and Black investors, here's a bunch of capital going in that direction. Instead, we built a team. And we built a team focused both on capital deployment and on adding value after we invest. In Miami, we didn't just say Miami is interesting, let's deploy capital. We relocated a significant chunk of SoftBank Group International to Miami. This is now the largest office for SoftBank Group International in the world, outside of the Vision Fund, which is the other really big piece of SoftBank. So we vote with our feet, with our infrastructure. We build to serve those markets. We don't just deploy capital, which is what a lot of other investors do.
And as you see, the life cycle of these startups go into now exiting opportunities. We've seen a number of, for example, the Latin American funds starting to come to the market, IPO in America, for example. How long do you have boots on the ground within that company? How long do you remain committed when you do see an exit?
We've built quite a flexible capital platform. So our idea is to fund a company from inception to IPO and beyond. We started with growth investing because that was the biggest need in Latin America. But over time, we've realized we need to do more than that. And so we've created a public investment strategy where we invest in listed companies, not just companies that we already own that go public, but actually already listed companies. And we have a few of those investments. And we've also launched an early stage fund that is focused on Series Seed and A, which is a very rare place for SoftBank to be investing. Why are we doing that? Because the rare asset in this whole game is the entrepreneur, the founder, the talented founder, and we want to catch them whenever we can, as early as we can. A big shift is happening in emerging markets in the types of businesses being built too. It used to be very capital intensive, online to offline businesses. That was the classic emerging market startup. Now people in Brazil are building software companies. Highly capital efficient. They'll need 1 or 2 rounds and never another. And so if we don't catch them early, we miss them completely. So for all these reasons, we want to be the most flexible capital provider in the region, from seed to IPO and beyond.
To go back to the competition, are you worried about valuations, whether it be across those based in Miami, those based in Latin America, those with people of color leading the business?
It's hard to say no, we're not worried about valuation. 2 years ago, if you thought something was expensive, now it's double that price, and so you must still think it's expensive, if not more so. So it's hard to remain intellectually honest and say valuations don't concern you. But I think it's important to distinguish between businesses where valuation matters and businesses where it kind of doesn't. The first category are businesses with a more constrained market where you really need to pay the right price because how big the business can get is constrained by some external factor. But there's a category of businesses that are redefining huge chunks of GDP. They're bringing massive numbers of people into the economy with services they've never had. It's difficult to size those markets. And with those types of companies, which are not common, they're few and far between, but with those types of companies, it's almost a good investment to get in at any price. When was Alibaba expensive over the last 20 years? Maybe at IPO, maybe a little after, but every period until that point, you could have bought Alibaba at basically any price. Same with Facebook and Google and these other transformative companies. Those are being built in Latin America today. And so if it costs 500 or a billion or 2 billion, in the trenches, that may seem like a huge disparity. But when you zoom out and look at it over time, 10-year time frame, which is our kind of orientation, then you have the appetite to stretch up. We don't like to because it does compress returns, but there's some companies that are truly special where you're willing to do that.
Talking about stretching, of course, you've decided that Latin America was so successful, you'd deploy a second fund, raise more money. You've got an interesting way with the opportunity fund in particular, in that you've said before, start with 100 million. Well, that could therefore mean it would expand, but also a novel way of not taking the traditional management fees and also reinvesting the 50%, I think it was initially, of the gains from the first fund into subsequent ones. Is that story going so well? Is the focus on entrepreneurs of color going so well that you are already looking to reinvest, are managing to expand those sorts of funds?
So the Opportunity Fund is very different from SoftBank's traditional activity because it's truly predominantly an early stage fund. Early stage funds take years to mature. And so it's very early to decide if it's being successful or not. But what we like to do is experiment. And we like to experiment boldly, not just with a few dollars. We like to build teams that are addressing the challenge. So in the case of the Opportunity Fund, as I mentioned before, we've built a full team. It's about 10 dedicated people, more than half women, almost 100% of them underrepresented professionals in the world of investing, Black, Latino, and we're dedicated to seeing this strategy through. So this is phase one, and phase one is find great founders, put capital in their hands, help them grow, show that you can generate returns with a strategy that is purely racially focused. If we execute stage one well, there will be stage two and stage three and stage four, and we'll expand the platform and be even more ambitious. But the hard thing to do is to build the team and to focus on doing it yourselves right. And that's still the phase we're in. So that'll last another couple of years. And then we'll think about other ways to expand what we're doing within that space of founders of color. But so far, so good. A number of companies are raising subsequent rounds. A number of companies are growing really healthily. We're doing follow-on rounds in companies we invested in earlier because they're progressing well. So we're very encouraged by what we've seen so far.
Of course, what was so discouraging, I get my English right, to begin with, was that about, 1% was the stat of VC-backed founders are Black. Is that changing? Do you think that with your help and others that we're moving the dial?
No, we're not moving the dial. This is the first step on a very long journey. The path from here to equity is not overnight. It's probably generational. I think the important thing to do is stick with it. A lot of the magic of startups is you create companies that create value, and the people from those companies then create other companies that create value. And building that ecosystem that pays it forward is what creates the magic of San Francisco, for example. It's why it's so difficult to replicate. And so with these founders of color, what we need to do is stick with it. We need to fund companies through the liquidity events, have them fund other companies, create a flywheel and a community of founders who can all relate to each other and inspire each other and build with each other. But that takes time. We're in the very, very first innings of this journey, and we can't do it alone, frankly. I encourage other companies to follow the example we've set, not just to deploy capital to other people who are then going to deploy capital. That's the easy thing to do. The hard thing to do is to build an actual investment practice. And the reason it's important is the brand that SoftBank brings to these communities and these founders is much more helpful than the capital. They might be able to scrap together capital for here and there. But if they can say SoftBank invested, it validates what they're doing to employees they're trying to attract, to customers they're trying to sell to. And you have a number of big brands, big established financial services and other brands who can lend their brand in a similar way to validate these founders. That's much more powerful than giving someone else a check to then invest. So I think the template we've established is a very good one. Yeah, go ahead.
I want to talk about that validation, and this is a sensitive topic, and I want to address it with as much sensitivity as I can. But the Opportunity Fund, how many of those great entrepreneurs that you say you find and you want to put the capital in their hands want to be backed by the Opportunity Fund, or actually want to be backed by a more general fund, the Vision Fund? They don't want to be taking money because they're a Black or person of color founder. They want to be taking money because they're a great founder, no matter what.
Yeah, it's a very important point. I relate personally to that. You don't want to be at the kids' table. You want to be at the adults' table, so to speak. The good news in our case, which is why I think big firms have the same advantage we have, the good news in our case is we do not have an early stage fund. There's no other investment vehicle that would fund the companies at that stage. So in many cases, this is the entry into the SoftBank ecosystem for all these firms. And when they talk about where they got the funding, they just say SoftBank, which we love. It's a little irrelevant which vehicle it comes from. They say we have been funded by SoftBank, and that helps them recruit, it helps them sell, it helps them feel they're on the right path, it helps them tell their communities that they're doing something that's not too risky, which is a very important thing for a founder who doesn't come from the traditional background. So we think that validation is present even in the construct that we've built this fund.
Talk about the community you now sit in over in Miami and the validation, it seems, that's happening day in, day out, people moving to Florida. I mean, we just heard today ARK is moving its headquarters to Florida. Miami, you in a way, it's an embracement of diverse entrepreneurs too, looking at Latino, looking at Black founders, looking at female founders. How has Miami taken shape? How much will it continue to be a force within investment, do you think?
We're very bullish on Miami. I think what the administration of Miami, Mayor Cava, Mayor Suarez have done in the last year is incredible. They've opened their arms and said, Come, we'll help you. Let's do something great together. It reminds me a lot of time I spent in Dubai. It reminds me a lot of Singapore. There's certain elements that Miami has now that make it a contender as a global megacity, and the administration of Miami is embracing that challenge. So there's an energy in the air here that's pretty different. Of course, the tax regime doesn't hurt. So a lot of financial firms who think with their Excel spreadsheets do the math and say it's better to be in Miami. But that's not it. That's always been true. What's happening now is a bit different. There's a bit of an organic community forming here. And I think that strength begets strength. So Miami is going to take advantage of this hype moment and turn it into something more lasting. That's a bit of the challenge, but it's their opportunity to lose. And we as SoftBank are committed to helping the city do that. We've relocated a huge number of our people and our resources here, in part because we believe in Miami. In a sense, Miami is like a company we're funding. It's a growth stage company. We're excited about it and its team and its founders, just the way we would be about a startup. And we're here for the long haul. We think Miami is going to be a great place.
One thing that worries you, Sheila, because you feel your sort of positivity, your energy, it's infectious to a certain degree. But we're now talking to investors across the board who are worried about valuations, and you, of course, have a healthy realization of perhaps things have got expensive, but they're worried about which way the market's going, which way inflation's going, which way interest rates are going. Is anything particularly worrying you in the space that you invest in right now?
The beautiful thing about tech, and I'll talk about Latin America, is it's not about disruption anymore. This isn't about shifting market share from one player to another. It's about bringing huge numbers of consumers and businesses into the economy for the first time. That is a secular trend that does not care about macro, does not care about inflation. It is massively inclusive and therefore massively durable. So I think the growth opportunities for companies that are bringing people into the economy for the first time sees through this noise. And we think about a 10-year horizon. I think there's no reason to be concerned about valuations and dips now and again if you think that in 10 years you're going to have millions and millions more people included in the economy because of these tech startups.
Sheila Nyatta, wish we had more time. Absolutely fascinating conversation. Stay well. Come back to us. Thank you very much indeed, Managing Partner over at SoftBank International Group.
I'm David Weston. I'm delighted now to welcome the former Treasury Secretary, and now he has a new job. He is Stephen Mnuchin, and he has a new fund called Liberty Strategic Capital. Stephen, thank you so much for joining us today. Let's go right to your new job. Tell us about this fund. Tell us about the fundraising, how much money you have. What are you going to do with that money?
Well, David, first of all, it's great to be with you. We're focused on areas that are critical to both national security and important transformative issues. So we're most focused on technology with an emphasis on cybersecurity, national security, data privacy, and fintech and financials.
So let's talk about fintech in particular, because there's a lot of talk about fintech. I think different people mean different things. When you talk about investing in fintech, where are the investment opportunities?
Well, we really like the payment space. We think that's a gigantic opportunity, particularly for real-time cross-border currencies. I think the underlying technology of blockchain and using stable coins is something that's very interesting. But let me just comment, because I saw a Bloomberg article this morning on one of the big stable coins. In my view, one, some of these stable coins should most likely be regulated. And two, if they're backed by dollars, they should be freely transferable, and we should make sure that they're really backed by dollars, so that dollars are held by a custodian bank and that they're secure.
Yeah, let's go exactly there. I'm glad you raised that, because there was a piece on Bloomberg today. It was about Tether specifically, saying that right now they have 69 billion tethers outstanding, and 48 billion of them were issued this year. Theoretically, that means they have $69 billion of more or less U.S. cash somewhere. How assured are we that they actually have that money?
Well, I don't know much about Tether other than what I wrote about, and I thought the piece was actually quite interesting. But again, they shouldn't be like casino chips. They should be, in my opinion, if you're going to issue a stable coin, the actual money should be held in a regulated bank, in a trust account, and the people who hold the stable coins should be able to exchange those for real dollars at any time. So the stable coins should be invested in U.S. treasuries or things that look like U.S. Treasuries, money markets of highly liquid backed investments.
Stephen, it's not your job anymore. It was your job. Now it's Janet Yellen's job to figure out how you should best regulate that. She's had some meetings, as you know, to try to figure out regulation of things like stablecoins. From your point of view, is that something that should be the Fed's responsibility? Is that the SEC? Where does that responsibility lie?
Well, the Secretary of Treasury oversees a committee of all the different regulators, and that's the right place. So these issues cross different regulators. Some of them are Treasury regulations through FinCEN. Some of them are the OCC for banks. Some of them are the Fed, and some of them are the SEC. And in general, I'm fine if people want to trade Bitcoin and cryptocurrencies, but I think there should be full transparency. These shouldn't be the equivalent of a Swiss numbered bank account. So if you're going to trade in these, they should be fully regulatory compliant, fully BSA compliant. And one of our big issues is to focus on cybersecurity. And again, one of the problems with ransomware is right now, it's way too easy to pay a $25 million ransom payment in Bitcoin. You can't wire $25 million to people who you don't know. You can't deliver cash. I believe the regulation should be same on these other cryptocurrencies.
So as you look to make investments with your fund in this area, how vulnerable are your investments to sort of regulatory changes? I mean, is that a risk, an opportunity, a little bit of both?
Well, as I like to say, I've been regulated when I ran a OCC bank, and I've been a regulator. So I understand both sides. We actually like investing in companies in regulated entities because we think the legal and political risk is a lot less. And we think there's safety in a regulated institution, particularly whether a U.S. institution, whether it's regulated by the OCC or regulated by FinCEN or regulated by the SEC. So I, as an investor, would be very careful investing in unregulated entities. There are clearly places where it makes sense to do that, but one has to be aware of the regulatory risk.
Mr. Secretary, do you have a sense of the possibility of contagion? Let me be specific. Let's go back to Tether for a moment, just because there was this piece just written today about it. There's a suggestion that perhaps if Tether collapsed, I'm not saying it will, but if it did, it could affect other cryptocurrencies. Is there a danger of contagion across cryptocurrencies?
Well, let me just say, I'm less focused on the contagion. I'm more focused on there are people who are buying that, thinking they're buying the equivalent of US dollars. So when you say you're buying into a stable coin backed by US dollars, there should really be US dollars there. So whether it's an issue that drifts into other things or whether it's just investors can't get their money back, I think that's a big problem, and that's a regulatory concern.
Let's look forward, if we can, in success with the payment systems really going into digital currencies, whatever we call them. How does that work? What does that do to our current payment system? Because our current payment system, both domestically and internationally, is a bit long in the tooth, I think it's fair to say.
Well, let me just say, the Federal Reserve payment system for large transactions works extremely well. The smaller payment systems, to a large extent, still rely on ACH, which is an older technology and not necessarily as secure. And what I'm most focused on is what I call real-time payment systems cross borders, where we allow consumers to be able to transact peer-to-peer across country in a very efficient way. People shouldn't have to pay 5 or 10% or 3% commissions, for that matter, for transferring their funds. These should be things that are done at 25 basis points or 50 basis points. And I think this is a great economic area and great for consumers.
So, Mr. Secretary, there's one thing of moving from one payment system to another and the opportunities, disruption, but also opportunities of investment. Is it possible also that the overall size of the pie will grow? I mean, Ishwar Prasad, actually from Cornell, has written a book saying, this is an opportunity to have more democratization of the financial system globally.
Well, I think that's true, and particularly outside the U.S., it's even harder for people. I mean, in the U.S., there's still way too many people that don't have access to bank accounts, and that's even more of a concern as we go into the developing countries. So I think this is a global opportunity. It is something that I think is a very attractive opportunity.
Give us a sense about the global competition in the space. Where is the United States in comparison to Europe and, let's be specific, China with respect to digital payment systems? Are we behind?
Not necessarily. And let me just say this is a long issue. So, I mean, again, the payment systems work very well in the U.S. They can continue to work very well. I know there's been a discussion about a digital currency for the Fed. That's something that Chair Powell and I discussed. I think at this point, there's not a need for a digital currency from the Federal Reserve or the Treasury. I think the private markets can solve this. In the case of China, they have a digital RMB. I don't see that as a competition for the US dollar. The US dollar is the reserve currency of the world. And I think for the foreseeable future, given the safety and soundness of the dollar and the US economic and political system, it's going to stay that way.
In success, once again, of a digital payment system, a digital currency broadly used, what does that mean for the big banks? There's some suggestion that they may get, I guess the word is disintermediated.
Well, I think to a large extent, in every single financial services company, that there is a transformation using technology. And actually going back to 1999, when I worked at Goldman Sachs, Hank Paulson, who I worked for at the time, asked me to come and work as part of the executive office because I was a big user of technology, and he foresaw technology impacting everything at the firm. So I eventually became CIO and oversaw all of technology across the firm. So this is an effort that's been going back over 20 years. Obviously, in terms of banks, the move from bricks and mortar branches to online banking is something that's very important. And I know all the big banks are embracing this change today. So they need to continue to invest in innovation. My guess is we'll partner with some of the big banks. Some of the systems they'll incorporate, and some of them there'll be competition as outside fintech companies compete with them.
Talking about competition, what is your appraisal of competition in your space right now? As you go to invest in some of these new payment systems, these new companies, who else is out there investing? How diversified is the pool of investment in the area?
Well, there's definitely, let me just say, there's a lot of capital on the investment sidelines in all these spaces right now. We are particularly focused on areas where we have a lot of expertise internally. So where we're investing in companies, we're actively involved in the board, we're actively working with CEOs to help grow these companies. In the case of Cybereason, which was our first investment, I speak to the CEO every other week. We have a strategic dialogue on helping to grow that business. And in the cases of particularly national security, cybersecurity, fintech, we have a lot of internal capabilities, combining both our government experience and my prior private investment experience.
You've mentioned cybersecurity a couple of times now. Talk to us about cybersecurity. How can you, with your new fund, invest in cybersecurity? What does that look like?
Well, let me just say, I think cyber is the number one most important strategic issue to every single company around the world. And I don't think there's one solution. And I don't think this is a one-year issue. I think it's a 20-year issue. So I think that we as a nation need to have very strong cyber defenses. And companies need to have strong cyber defenses. So when I was Treasury Secretary, I was responsible for cyber for all of financial services. That's an area which has invested a lot. We worked very closely with the private sector. We worked very closely. I oversaw all the regulators, and we used to look at drills on cyber risk. I also oversaw the IRS, where I was very focused on technology modernization and making sure that they had the proper cyber protection. So this is something I've been focused on, as I said, while I was in government. And now in my private capacity, we'll be making investments in companies that have great cyber products. The first one, as I mentioned, was focused on endpoint security. We're now looking at application security. We're also looking at operational security, which protects infrastructure. And again, I think that every single company needs to have a cybersecurity plan.
You've talked about how much money is out there available for investment. Are there enough opportunities? I mean, the reports are, at least, you've raised something like $2.5 billion, a lot of it from some private wealth funds in the Middle East. Are there enough opportunities to put that kind of money to work?
Well, let me just say we have a very diverse investor base, including international investors, including some sovereign wealth funds, U.S. insurance companies, family offices, both in the U.S. and Europe. So we have a diverse investor base, and we're comfortable that there's a lot of opportunities. We'll probably invest in something like 15 to 20 companies, so we're limited in what we're looking at. I'm actually on my way to Israel this weekend. We'll be opening an office in Tel Aviv, where we have very good relationships there. There's great technology coming out of Israel, and we think these are global opportunities.
Yeah, what do they call it? Startup Nation, I think, was the book that was written about Israel. Let's turn back to some of your old responsibilities with the U.S. economy. What's going on? Let's start with Washington right now. We have sort of a crisis of sorts over the debt ceiling. Apparently, they may come out with a way of postponing the issue until early December. What do you make of what's going on in Washington right now?
Well, let me first say that, I, as a former Treasury Secretary, and I think all the former Treasury Secretaries agree that we cannot let the U.S. default on its debt. The U.S. debt is critically important. As I said, the dollar is the reserve currency. So I am 100% supportive in seeing the debt ceiling raised. And I'm glad to see that there's been a compromise, it appears, between the Republicans and the Democrats. Now, let me just say, I'm most proud of the fact that during the COVID crisis, we passed two bills in the Senate, first 96-0 and the second 100-0. So there was enormous bipartisan support. That was $2.3 trillion and then $700 billion. And then after the election, we passed another $1 trillion on a bipartisan basis. So $4 trillion, that was a lot of money. I'm somewhat concerned about the additional spending that's going on now and the inflation. And again, when you talk about the debt, I think there needs to be a discussion on what's the appropriate amount of government debt. Pre-COVID, we started with 22 trillion of GDP and approximately 22 trillion of debt. We're now up to 28.8 trillion of debt. And I think to fund the current obligations that the administration has made, my guess is it's over $30 trillion. So, we were at something like 100% debt to GDP. I think, to the extent that some of these other programs get passed, we'll be up to 32, 33 trillion. I think 140% debt to GDP is a very dangerous issue. So I think the discussion in Washington, when people say things are budget neutral, if they're budget neutral, they shouldn't be increasing the national debt. So I think there should be a discussion around what is the appropriate level of national debt and appropriate spending.
It's interesting. You hear that from a lot of people, even some people in Washington, I will say. At the same time, I don't get a sense that this discussion of the debt ceiling actually triggers that kind of meaningful discussion over the long term. What is the appropriate level of debt? What is the way to have that discussion? Because I don't hear it.
Well, look, there's certain things in Washington we do very well. There's certain things we don't do so well. I mean, in any business, you typically talk about when you make commitments, how you're going to finance those commitments, whether it be raising equity, using cash on the balance sheet, or debt. So I think the time we should be discussing what's the appropriate national debt is, it's the same time when we make those commitments. Now, if you go back to 2019, Speaker Pelosi and I negotiated in 2019 a 2-year debt ceiling agreement and a 2-year caps agreement. And Speaker Pelosi was very clear publicly at the time, she wouldn't agree to a debt ceiling increase unless we agreed to a spending increase. Mm-hmm. So I worked very closely with President Trump, with Mitch McConnell, with Kevin McCarthy, and we negotiated a 2-year deal that was 2 years of government spending and 2 years of debt. And that's the appropriate time to do these things together, in my opinion. So I think the debt ceiling discussion should be happening at the same time that there's a discussion on spending. And, I'm proud of the fact that we did spending on a bipartisan basis. I think using reconciliation for spending is a dangerous precedent.
So give us your opinion as a former Treasury Secretary and also as somebody who came from Wall Street, really knows the business world, about the proper way of promoting growth in the United States. And we have monetary stimulus, which goodness knows we've had a lot of from the Fed. The Fed says they're going to start coming off of that. Now we have enormous fiscal stimulus. What about that transition from monetary to fiscal? Is this a healthy thing? How much fiscal stimulus should we have?
Well, again, you got to put this in perspective because COVID was just, an extreme emergency. And look, anybody who ever ran a downside on a business never anticipated zero revenues. And that was because the government made the decision to effectively shut down the entire economy for medical reasons, which I think was the right decision. So again, the $4 trillion of spending we did was an emergency. And the Fed responded appropriately, and the fiscal Congress responded appropriately. But we're no longer in the same medical emergency we were in then. The good news is we have vaccines, we have viral treatments. There's no question the medical emergency is not the same. And there's no question we need to normalize both monetary and fiscal policy. I think there's no question the Fed has to, at some point, taper the portfolio and right-size the Fed balance sheet and normalize interest rates. And it's just a question of how fast they do that and where we end up on interest rates. And again, personally, I do worry about inflation. I know this is an area that actually Larry Summers, some of his public comments, I agree completely with.
Yeah, exactly. Larry's been on Bloomberg and talked about this repeatedly. What is your view right now on inflation? Is it transitory? Do we have a longer-term problem that we're looking at?
Well, there's no question we have inflation today. The Fed models and the Treasury models don't necessarily are able to predict what's going to happen in the future because, again, of the extreme fiscal and monetary response. My concern is that we will have inflation. This inflation will continue. Some of it may be transition, but look at energy prices. I mean, something I never thought we'd see during COVID is you saw negative prices of oil. But, now the Biden administration is talking about releasing oil from the strategic reserve. Clearly, we have inflation in energy. The good news is the economy is rebounding very strong. Labor prices are up. So I do worry that this will be ongoing inflation, and we could easily end up with 3.5% 10-year treasuries, which again just increases the cost of the national debt and creates budget issues.
As you said, Mr. Secretary, we no longer have the medical emergency that we certainly did before. We're not entirely out of the woods, but it's not like it was before. We don't have the economic crisis that we had before. At the same time, as we turn to a normal approach, talk about investment, because some people would say, look, we should have been investing, for example, in infrastructure all along. We need to catch up. Are you sympathetic to that? In fact, is investment in infrastructure not as likely to be inflationary?
Well, I support the bipartisan infrastructure bill. I think that actually those are long-term investments. So I think that, no, not every single part of that bill do I agree with. There's clearly issues I don't agree with. But look, that was done on a compromise, and there were issues that both parties got. So I think that that's something that's important. That's different than, the ongoing fiscal response. So whether it was the additional $2 trillion that was done under reconciliation, or it's the, what started as $3.5 trillion that may now end up as $1.5 trillion of additional spending, that's very different.
So you do have the experience of both Wall Street, the business world, and Washington. Give us some sense. Do you think there is a prospect that we can actually get together, Republicans and Democrats here, and operate on some of the more long-term issues, such as the level of deficit, such as investment, come together? I won't even call it bipartisan, but just agree on a plan.
I do. Look, I'm an optimist. We did this during the CARES Act. There's no question, had we not all come together, there would have been a global depression, not global recession. And there are clearly areas that both parties disagree on, and there's clearly areas that both parties agree on. Some of the legislation that was recently passed in the Senate that's sitting in the House, I think the House should move it forward.
Okay, Mr. Secretary, thank you so much for your time today. That is former Treasury Secretary Steve Mnuchin. He is now head of Liberty Strategic Capital.
Thank you, David.
Hello, everybody. A warm welcome from Dubai to the next panel. A very important conversation, not just around the ongoing vaccination rollout globally, but also the investment landscape more broadly. I want to get to our next panelist, that is the CEO of the Russian Direct Investment Fund, the RDIF, that is Kirill Dmitriev. Kirill, let's start with Sputnik 5. I mean, when sort of it first was put into production, it was a part of a big idea, a big vision to put Russia on the map of a global vaccination drive. When we last caught up over the summer, you said, hey, we're going to reach 800 million doses by the year end. Are you still on track for that?
Yes, Yousuf, thank you so much. And first of all, I'd like to stress that it is indeed a very joint struggle of every country, including Russia, fighting with the virus. You know, we are fighting with it together, and we are bringing to this fight our 250 years of vaccine experience in Russia. And we are on track to our target. Maybe will be delayed by 2-3 weeks, but we are ramping up production significantly. And what benefits us is that already 24 production partners of RDIF in 13 different countries are already producing Sputnik V and Sputnik Light vaccine as we speak. And this partnership approach that Russia demonstrated, enabling different countries to have production of Sputnik V, enables us to ramp up production quite quickly. So we'll be producing more than 100 million doses, including Sputnik Light in October. We'll be increasing production more in November, and by November, more than 50% of Sputnik V and Sputnik Light will be produced outside of Russia.
There have been some supply issues, especially with the second dose of what is a 2-dose vaccine. Complaints from Brazil and Guatemala. There was a scathing letter from Argentina that made headlines just a few weeks ago. How can you reassure them today about some of the promised deliveries?
Well, they are already reassured because we caught up with the second component delivery. And just as all of the other producers have had some delays, there were some delays with second component, but they have been resolved in all of the countries already by now. We delivered more than 7 million second component over the last couple of weeks, so those issues have been resolved. And what's very important is that actually the first component of Sputnik V, we call it Sputnik Light, and I'll talk about it a little bit more, produces better protection than many of the 2-shot vaccines. And we'll share unique data next week that against Delta variant, and this is, I'm telling it to you for the first time, the Sputnik Light produces better protection than most 2-shot vaccines. So when we delivered first shot to all those countries, and you see Argentina cases, by the way, declining 30 times over the last 4 months. Really, it's a huge success story for Sputnik V because Sputnik V really contributed to a very successful vaccination program. And unlike some surges you see in some of the Western countries that did not use Sputnik, Argentina shows that using Sputnik has really stopped the epidemic, and the numbers sort of demonstrate that.
So would you consider Sputnik Light then a new generation, a new version, sort of a 2.0 that maybe has improvements in the second dose portion of this 2-dose vaccine process? Is that an accurate way to describe it?
Well, Sputnik Light is a very important initiative. It's just our first dose. And we just saw that first dose produces great effectiveness. So it's 80%, more than 80% effective as a standalone vaccine. Actually, Paraguay study showed efficacy of more than 93% as a standalone vaccine. But this is also a vaccine that can be a booster to other vaccines. So it's a standalone vaccine and a booster. And frankly, it's the first booster registered in the world because we understood that boosters are needed. So we are testing this booster with AstraZeneca combination, with Sinopharm combination, with Moderna combination in Argentina. And we believe that eventually it's a combination of the vaccines, including adding Sputnik Light booster, that can be the ultimate solution against many of the existing and emerging mutations.
Can you shed a little bit more light on any of the real world data that you've been able to gather? Because you've deployed your vaccine to millions more people around the globe. You have probably a much better idea today of where effectiveness stands compared to where it was 3, 6, 9, or maybe a year ago. Where are we? 85, 75? Does it vary even geographically? What are you seeing?
Thank you, Yousuf. And yes, so first of all, the benefit of Sputnik, it's already registered in 70 countries with 4 billion people, representing half of the world population. And we have data from tens and hundreds of millions of people. So basically, we have real data from 15 countries that has been published already in 20 publications. And what this real data shows is an incredibly safe profile of the vaccine. So it has the least side effects based on Mexican data. What's very important, it doesn't show a track record of some of the rare cases that some other vaccines are having of myocarditis and CVT, cerebral venous thrombosis, so we don't have that. So it's a very safe platform, by the way, that showed historically safety over long term, which is very important. On the efficacy, we see efficacy against Delta of 83.1% for Sputnik V against infection and more than 94% against hospitalization. So the key for us, Sputnik is very effective against Delta, and it showed in all of the clinical real-world data. And very importantly, we don't see major decline in the effectiveness. Actually, Argentina study showed the effectiveness of Sputnik increases over a period of 4 or 5 months, while for some of the other vaccines, it actually decreases.
I mean, here's the issue, Carol, because I listened to all the progress you've been able to make, and you're describing it as positive, as sort of new milestones, as moving away from some of the difficulties of the early beginnings, as it were. Why then hasn't the WHO signed off on all of this? When are they going to come on board?
Well, we are in the process with WHO, with EMA, and they're being very professional, and they do all of their steps, sometimes bureaucratic steps that are needed. Our Ministry of Health confirmed that all of the barriers have been removed, and we believe there will be a visit of WHO soon in October to Russia. But very importantly is that the vaccine has been not only approved by 70 regulators, but it has been used on 10 million people and showed one of the safest and most efficient profiles. So we have no doubt of WHO approval. They just need to go through their motions. And I think it's very important that this vaccine already has been used very actively in the world. And we expect WHO, by the way, to also separate vaccine approval, which is a very important track, but also work on vaccine certificate acceptance around the world. Because it's very important, while bureaucracy continues to work on vaccine approval, vaccine certificates are interchangeable and accepted around the world. And that's a very important track that we believe is important to resume the world travel.
Do you have any capacity to get into some new agreements to spread out the vaccination rollout as we get into 2022? What are some of the other countries that you're speaking to? Or are you pretty much, you've got your orders full and your hands tied at this point?
Well, I think we really recognize our sort of role. We want to make a contribution, but we definitely have no production capacity to be the vaccine for the world. So we believe vaccine portfolio is the answer for the world, because you cannot bet on just one technology. You see some fortunes of technologies go up and down, some declines in efficacy over 5 months to below 50%. So vaccine technology landscape is changing, and the only way to feel secure is to have a portfolio of different vaccines that we believe Sputnik can be part of. So we want to make a contribution. We are not trying to get a huge market share. Each country we go to, we say we do not want to be more than 20% of your total vaccine supply agreement, because frankly, we have demand significantly overstripping our supply. So we'll be working with existing countries, trying to make contributions. Sputnik already is the main vaccine for vaccination in Russia, and we just want to work with others, be a partner with others, and work in a positive partnership manner with other vaccine producers as well.
How much progress have you been able to make domestically? There was quite a bit of criticism coming across in terms of how the initial rollout was handled. There was hesitancy and reluctance on part of major parts and portions of the population. Where do we stand today?
Well, first of all, Sputnik is definitely accepted as the most popular vaccine in Russia. And already almost 50% of the population has been vaccinated. Now we want to have, of course, higher vaccination rates. And frankly, Russia has been a little bit of victim of its own success, because it handled the initial stage of epidemic very well. So when Delta came in, many people didn't really realize how serious COVID is. But now vaccination rates are increasing, and definitely Sputnik is a big part of that. So we believe that vaccination rates in Russia will continue to increase. And Sputnik, of course, is the core part, the main part of the vaccination program in Russia.
I want to sort of get to a bit of an overview on what is happening in the investment landscape. But you have, of course, teams that are working across the world to try and find opportunities. But just in terms of the state of the global economy, a fragile recovery post-COVID, what is your read on the situation at the moment?
Okay, I'll go there in just 1 second. Let me give you just one thought that I think is important on the vaccine, and we'll finish with the vaccine stuff. Because I think one initiative that I would like to propose again for the first time given this conference is that we believe it's very important to have much more of a direct comparison of different vaccines. So, for example, what we are doing with Argentina, we have combo trials of Sputnik with AstraZeneca, with Moderna, with Sinopharm, and it's all compared on the same data set on the same population. So I think one initiative that we'd like to outline is that there should be more direct comparison of how vaccines work with new mutations and not just have data from different countries, but have it all in the same place. But going on to the vaccine landscape, I think it's very important to recognize the reality is that, first of all, I think the great news is that many people were afraid that pandemic will really destroy economies, but the world has recovered. Many economies are recovering, and that's great news. I think also the cost of this is huge inflation. And we see that almost 40% of new money has been printed by some economies. We see major inflationary pressures in agriculture and natural resources. So the question is, how do you basically preserve wealth in this high inflation environment? And we believe there are several answers to this. One is private markets. So we believe that public markets, really very high valuations. So private markets is the way to go. Of course, technology will play a huge role, artificial intelligence, genetics, and of course, by the way, Moderna stocks and other stocks have showed the great promise of technology, but again, they're public stocks now, and we believe that they're quite fairly valued. And definitely natural resources. So Russia, as an owner of a big part of world natural resources, will definitely benefit from the high inflation environment.
Right. I want to just build on what you just said in terms of the inflationary pressure that you're seeing across supply chains. It's something that we talk on Bloomberg TV about a lot with some of the CEOs and the leading officials. But are you able to do anything to mitigate some of those pressures, or are you going to have to pass these costs on to consumers? How big a change are you seeing, and how much does it affect what RDIF does day to day?
Sure. So our benefit is that we have a network of partners who are the top sovereign wealth fund partners in the world. And all of them are concerned now about preserving and increasing the wealth, given that valuations are so high. And the question is, do we go into public markets and then possibly have some risk, or how do we deal with it? So we have big discussions about what actually preserves value in the new environment. I think initially there was lots of value to be captured through technology stocks. And this is why, lots of value has been sort of going to technology stocks. There are lots of things that we are doing in infrastructure investing and basically making infrastructure investments that are inflation protected. And also investments in agriculture, natural resources, sort of by definition, investment protected investments. So we are looking for pockets of such investments, and basically investment protection from inflation, I believe, is one of the core themes for many people to think about. Now, the problem when many people with lots of money think about that, it leads to more inflation. Yeah. So this is something the world has to work through.
So what exactly are the geographic priorities here? Where are we going to see the RDIF do more deals?
So we, of course, invest quite a bit in Russia, and Russia is about 80% of our investment mandate. And we see actually quite low multiples in Russia because of a number of historical reasons, of a number of perceived risks that are out there. So we actually believe that Russian public market has still some ways to go, and Russian companies represent very attractive investment opportunities. But we're also investing in China. We have been investing in the Middle East and Europe. And once again, the benefit is that we have more than 20 partners in different countries. So we try to either make Russian companies more global by partnering with them, or investing in opportunities that our partners offer and bringing those opportunities to Russia.
Kirill, it's been, about 6 months, a bit more than that, since the new U.S. administration under President Joe Biden's taken over. They've kind of found their feet. I'm wondering whether you're seeing potential here of a shift away from what was quite an acrimonious relationship with the United States, between the United States and Russia, and whether there is a window of opportunity for some kind of rapprochement that would help ease some of the sanctions.
Well, Yousuf, yes, thank you. I think the world will definitely benefit from a better relations between U.S. and Russia on the economic side and on geopolitical side. And I think what's been positive are some of the direct conversation that President Biden and President Putin have been having. So this communication, this really open discussion of issues, I think is very important as foundation of a relationship. And I think also there should be more interaction between Russian and U.S. business that can provide more of a framework of also discussions. So not only the difficult geopolitical questions I discussed, but ways to really invest together and do things together. So we are quite hopeful that those direct discussions are creating the foundation of a better relationship. Russia has always been open to a better relationship. We want to be partner with many countries in the world. So let's see how it emerges. I think it's great if U.S. and Russian business can play their role to make relationship better and make relationship more economic and business focused as well.
A closing question on your biggest concern outside of some of the material that we've discussed. Is there another risk factor, be it perhaps instability in China on the economic front with the Evergrande debt saga, or another pocket of the world where you see the potential of quite a bit of derailing of sentiment and confidence?
Well, I think a big situation to watch is the gas prices in Europe. And Russia is interested in stable energy prices. We played a big role in stabilizing oil prices to avoid fluctuations. So many people would think those things benefit Russia, but in reality, we believe that long-term supply contracts are a way to solve some of the energy issues. And I think energy shock can be quite significant. And in addition to energy shocks, of course, there are bio risks, terrorist risks, but we believe that, transition to green energy, but in a meaningful way, is the best way to go to avoid energy shocks.
Kirill, this has been a real pleasure and always is. Thank you for making the time and for sharing some of your views with our global audience. That is Kirill Dmitriev. He's the CEO at the RDIF. Thank you again.
Thank you, Yousuf. Thank you very much.
Welcome, everyone, to one of the most fascinating moments of the year where we get to really dive into real estate, a market that's been on fire despite some concerns, even in areas that had been high concern spots, including the centers of big cities where everybody declared the office dead. And now everyone wants their employees to come back. Joining us today, I'm so pleased to say, Adam Schwartz. He is co-chief executive officer and co-CIO of Angelo Gordon, with many years of experience in the real estate market. And I'm learning that the real estate world is relatively small and everybody knows each other very well. Lauren Hochfelder also joining us. Lauren Hochfelder is managing director of Morgan Stanley, as well as the deputy chief investment officer at the Morgan Stanley Real Estate Investing Group. And there is this idea right now that there still are gains to be had as more people look to private assets and as yields remain low. Adam, Lauren, let's just start with a state of play of where we are. How much more value is there left? Is this still a hot spot for people who want yields? Lauren, let's start with you.
Sure. Look, I think it really depends on the type of real estate. As the prospect of higher interest rates come, presumably off the back of higher inflation, I think the tides are shifting a bit. In a low rate environment like where we've been, there's been tons of investor demand for long-term leased assets that provide current yields, some inflation protection, et cetera. And we've seen yields compress materially for these long duration, frankly, risk-off assets. But now as the world shifts and as we all sort of wake up to this prospect of inflation and rising rates, I think those assets with long duration leases are frankly more exposed, more at risk than other places, whereas other types are more resilient. We're focused on areas of real estate that tend to do well in inflationary environments where economic growth and secular tailwinds can outpace, can propel NOI growth that really outpaces interest rate hikes. So it depends, but we do still think there are opportunities where we can grow income more than cap rates should widen.
Adam, do you also see this as sort of a perilous moment for high duration?
Yeah, I agree with what Lauren is saying. I mean, I think, when you look at, I think the best proxy to look at is probably the fixed income market. And The IG universe right now is basically trading at negative real interest rates, right? And the spread that you can achieve from buying real estate relative to buying, whether it's IG or high yield, it's pretty attractive. It's probably actually the most attractive that it's been since the 90s. The metrics that we look at would tell you that real estate, if you wanted to get to parity to sort of the long-term averages of fixed income in terms of the spread to fixed income, that would tell you probably real estate has another 20% of price appreciation. We don't necessarily believe that you're going to capture all that, but it looks very attractive on a relative basis. And there's, as Lauren said, a lot of dry powder sitting on the sidelines trying to get some yield. If we do get inflation, even better for certain types of real estate. So yeah, I think you want to watch out for those long duration fixed asset, fixed income type real estate assets, but those that are shorter duration have more upside, we believe.
And just to clarify, Lauren, when you talk about long duration, you're talking about leases that go for a very long time. The idea that if there are a lot of sort of properties or spots within a building, per se, that are extended out for a long period of time, is that long duration, or is there something else that also counts as such?
No, I do mean long lease duration. And I think in particular where there's no material CPI indexation, so where the income stays flat as rates rise.
Yeah,
so let's dig into some of the specifics.
Or more. So I was just going to say, Lisa, certain asset classes will do better in an inflationary environment. Those short leases, think of hotels or apartments where you're leasing them by the night or by the year. You're able to capture that inflation much quicker than a 10-year industrial or office lease.
Well, let's go there, because that sounds counterintuitive at a time when hotels are still struggling, certainly in the big city areas. Where are you seeing opportunities within the hotel sector, within the leisure industry, especially in areas that have relied on historically at least, on international travel?
Well, you nailed it. I mean, it is leisure. It's not corporate. It's not group travel. So we've been more active in that space. We bought the Four Seasons in Vail, Colorado, last year because we thought that, in an environment where people were not traveling internationally, where domestic and drive-to destinations were going to become more popular, that those types of assets would benefit. And so we're definitely seeing that, on the corporate side, on the group travel side, convention, where there's a long way to go. I think it's going to be a couple of years until people really get back to traveling the way they used to, if they get there at all.
Lauren?
Look, I agree with Adam. I think the question from here, though, is many of those drive-to leisure assets have appreciated pretty materially. I think, 18 months ago, 12 months ago, Adam and I might have been chatting and said, gosh, this is going to be this great opportunity for distress. And the reality is pricing has accelerated because of the trends that Adam referenced. So now we look at, is that fair pricing, or are the capital markets ahead of the fundamentals? And I think it just depends by market.
Adam, I want to dig into something that you said, which is you're looking at leisure, not necessarily business. So how do you know when you're catching a falling knife if you try to go into some of the hotels, some of the convention centers at big cities, versus actually finding value, given the fact that there actually is serious uncertainty about the outlook?
Yeah, I agree. There is uncertainty, but at the same time, we are paid to unlock value and find value. And there are certain markets where in a normal environment, it is extremely hard to buy and hard to penetrate those markets. So, as an example, we recently bought a hotel in San Francisco, which, so far has been very slow to recover. That being said, do we believe San Francisco in the long term will recover? It's a hub of technology. Do we think that there will be groups getting together there? Absolutely. We think there'll be travel. And we were able to buy something at a basis that we thought made a lot of sense. So, when you can identify an asset that you think is attractively priced, discount to replacement cost, sometimes you have to take that leap when the market is not there and assume that the business will come back, which we believe it will.
Lauren?
I agree. It's really those moments where the market throws away the baby with the bathwater. And for assets in particular, like hotels, where, you're not buying this off of current income. It's all about sort of your perception of where RevPAR, where income will go. Buying at the basis is everything.
So let's talk about the other areas in cities, in San Francisco, in New York, big cities that saw the office market absolutely decimated. Lauren, is this an area of opportunity, or is this an area of transformation that perhaps people have not fully priced just because rates have been so low and there has been such hot demand?
Yeah. Look, I think it's really not one size fits all. You're already seeing this wide dispersion in performance across different types of assets, also different types of markets. But, there are certainly, I'd expect that you'll see meaningful devaluation for commodity product in some of these markets that are more susceptible to work from home. In certain segments, those that are more exposed to functional obsolescence, where the CapEx needs are so enormous that your real yields are, frankly, lower than they may look on paper, and expenses growing, et cetera. So you can paint a bleak picture for certain segments. On the other hand, in stark contrast, the best quality assets in the better markets are at all-time high rents, all-time high values. And I think it's ultimately comes down to companies that are performing well, who want their employees back into the office, are investing in high-quality office space. And there are still a lot of companies that have strong performance in this environment and are making that investment. So you really just see this barbell. I think in real estate, we spent the last decade plus talking about sort of the bifurcation or barbelling of A and B malls. And I think we're starting to see that transformation in office as well.
Adam?
Yeah, I agree. I mean, we do not believe that this is the death of the office building. I think businesses and individuals get tremendous benefits from working together, not working from home. Collaboration, the culture building, the mentorship and training that you get. I think it's extremely important. I think employers recognize that. They view their office as just one of the tools they have to attract employees. Some people talk about the technology sector where they're maybe showing more flexibility towards working from home. That being said, Google just made a huge investment in New York City. They just bought a building that they haven't even taken occupancy of for $2.1 billion. So they're clearly signaling that they believe in the future of the office. They believe in the future of New York City, as do we. The whole concept of companies taking 20, 30, 40% less space because people are going to work from home certain days. I don't really think that's going to happen. I think that, people want to be together. They want to use the office as a focus for collaboration. Well, if you're going to collaborate and all come in on the same day, well, then you can't rotate and squeeze out those efficiencies from sharing desks and rotating. So I just don't see it. I think, when you look at office space as a cost for a corporation, their rent is typically in the range of 5 to 10%. That's probably a pretty typical level. If you're able to squeeze, 20% efficiency out of your rent, you're talking about saving 1% to 2% on your expenses. Are you really going to do that if it has a material impact on the quality of life of your employees? I don't really think so. But I do agree with that in terms of
every real estate official who I speak to or executive, they're all in the office. They all have been in the office, I will just say this, for months. So I don't think it's a complete coincidence, but it is notable to me, and your offices look great. I want to move on to warehouses and industrial spaces, because that has been a really hot area on fire. Record prices, people looking to transform C-level malls into warehouse space or something else like that. And I wonder if some of the value or all of the value has really been eaten up given the sort of competition and the vogueness, if I want to use a Tom Keenism, of this space. Adam, do you think that it's overheated?
It is certainly hot. Right. I mean, and it's been driven by e-commerce. E-commerce is booming through COVID. But not only that, I mean, you're seeing a lot of users of warehouse sort of shift their mentality and sort of, change from what was a just-in-time sort of supply chain process to maybe a just-in-case supply chain process because, with the challenges that we're seeing on the supply side, people want to hold more inventory. Stores don't want empty shelves, and there is a need. You need a home for that warehousing in the interim. So we just see continued demand there. Every square foot that gets built seems to get leased these days, but pricing has been extremely high, to your point. But again, it's a function of if you think that inflation is going to come and you can reset those leases to market rents, people are willing to pay low yields to capture that upside.
Lauren?
Yeah, I agree. Look, I mean, we need to ask ourselves this question anytime we see this magnitude of an acceleration in returns. Industrial returns on an unlevered basis have increased by over 23%, trailing 12. That is, that's a staggering level. But when you dip below, as Adam alluded to, a lot of that is the direct result of real strength and fundamentals. I mean, rents are up 10% plus nationally over the last year, and in many of the coastal markets in which we invest, 20 to 30%. So you're seeing sort of real strength in the numerator there. But look, admittedly, I think the other thing you're seeing is that significant yield compression, right? Cap rates have compressed, 110 basis points. And when cap rates are this tight, that's a pretty wide margin of compression. And I think obviously that's driven by a bet on the continued rental growth that we're talking about. But truly, I think it's also a narrowing of the universe of what real estate investors want. So you look back in the 1980s, for example, and 3/4 of private real estate investment was into office and retail. Those are not asset classes that investors want quite as much today, right? That is 50% today and probably trending down. So whenever you narrow the aperture of what investors want, that obviously drives up liquidity and pricing for the assets that fit the box. So look, we've had huge conviction around industrial, and it's been good. And I think to the extent, or I think for us, what we like to do is position ourselves where we can really create that product, manufacture that product to sell into that deep well of liquidity there.
Okay, when you say manufacture that product, are you talking about converting C-level malls? Are you talking about building new buildings? What are you talking about, Lauren?
Yeah, sometimes it's often building, it's often repositioning last mile product, so upgrading it for modern tenant demands. It's, look, there's a lot of talk about converting C-malls, but there's a lot of, let's call it complexity to doing that in terms of how the rights work with surrounding tenants and a variety of other factors of re-entitlement.
So Adam, shifting to retail, where is the value at a time when you have a gradual shift away from retail, as Lauren was describing internationally for capital? And it's frankly, in some ways, we're redefining what retail is to more of a warehouse kind of hybrid model with some sort of pretty storefront.
Yeah, it's a very tough question. I think we're going to continue to see evolution in the space. The stuff that we've been focused on has been more necessity, right? We're staying away from things like B and C malls. I think a lot of the concepts are just not very interesting these days. So we don't really believe in the future there. What we are seeing a tremendous amount of activity in is what I guess people are referring to as these dark stores. And these are sort of these immediate fulfillment companies. You're hearing names like Gorillas and GoPuff and Joker. These are stores that are leasing very small footprints, but very accessible to population centers. They're stocking those facilities with 2,000 items compared to the 10 to 40,000 items that a traditional grocer would stock, and they're trying to deliver those in 10 minutes upon demand. Will the business model work? I don't know. They're leasing a ton of space right now in urban environments, so we'll see how it evolves. But for the most part, we've been focused on sort of that necessity segment rather than just the traditional malls and generic commodity retail strip centers.
Is there more opportunity, Adam, in actually investing in an existing structure, or is it more retrofitting? As Lauren was talking about, the potential there that is complex, but potentially could reap pretty big dividends if the materials prove to be valuable, because it's hard to get these things, and building right now is expensive.
Yeah, building is expensive. So I think that to the extent that you can reuse what's there, that's great. The problem is, as we know in retail, there's just too much of it. There's way too many square feet per capita. And so a lot of the future of, that incremental retail space is going to be alternative use, right? Going to either residential or warehouse. I think what you got to focus in on is the sort of, supply constrained urban locations, or those key centers really accessible to the population.
So you mentioned residential, and I know both of you do focus mostly on commercial, but one of the hottest areas has been rental homes, buying up rental homes in bulk. And we've seen this, talking about what's hot and what's not. That's very much what's hot to such a degree that it's become a growing presence and, frankly, push for the prices ever higher. Lauren, how much do you get involved? How much do you step back? Is this a better time to buy or to sell in the rental home footprint?
Sure. Look, we have been investing extraordinarily heavily in this space, frankly, across segment, so Class A down to workforce housing. And the bottom line is these are the strongest residential fundamentals we've ever seen in many markets. You have market rents above pre-COVID levels. I think it's in 98 out of the top 100 markets. So this is a strong market. And yields have compressed markedly as a result of that and as a result of the expectation of future growth. So now we sit here and say, okay, well, how much more can it go? I think one distinction is, maybe unlike other asset classes where tight cap rates, at least from a U.S. perspective, not sort of from a perhaps Japanese perspective, from a U.S. perspective, tight cap rates tend to be an indication of an expectation of future growth that's on the come. And I think residential, one distinction I'd make is these low cap rates, at least in part, reflect market rents that are already demonstrated. So a loss to lease, right? In residential, you're signing new leases every month. And so you have more visibility into what the on-the-ground rents are that you can achieve. So we can debate sort of depth of demand at those rent levels, but I think you have a little more price discovery. So with residential, look, supply will catch up. We've got a hole to dig ourselves out of, having not delivered a whole lot of housing for this country coming out of the GFC. But inflationary pressures should be, so long as they're moderate, good for residential rental. And I think the ultimate, risk will be the sustainability of these rental levels, because some of these markets are popping up against affordability constraints, and that's real.
They are, but at the same time, you look at the for sale market, right, and you're seeing home price appreciation of 20% year over year, just staggering numbers. So whether you're renting or buying, there is no affordable option. Add to that the fact that input prices to build are going up, right? Whether it's labor, lumber, steel, depending upon what you're building, everything's getting more expensive. So the rent to achieve an acceptable return on cost is going to go up. So it is inflationary across the board, whether it's for sale or for rent.
When you talk about the rent being too damn high, I do wonder, though, whether, Adam, first of all, whether you're investing in this market, and second of all, if there are certain segments of this market, I'm thinking of the Sun Belt, that have gotten perhaps a little over their skis simply because people have counted on this migration away from big cities to such a degree that it'll take years to prove it out.
Yeah. It's definitely something we look at, right? You got to watch the income to rent multiples because trees don't go to the sky, right? So what we've been trying to do to improve our yield has been building. We've been building more often than buying on the apartment space because we're just achieving better yields through doing that. And we're kind of, we keep scratching our heads every time we finish a project and then go to sell it because the yields that people are paying just seem to go down a couple basis points every month. We just sold an asset in Austin, Texas at a sub 3% yield. it's brand new, the rents are at market, where is the upside? Someone is betting on continued rental rate inflation and the fact that, they can finance those assets extremely well. The debt markets are wide open in real estate today. Borrowing costs are very low. So, even if you buy an apartment complex at a 3, you're financing it in the 1s, right? You're generating probably a mid to high single digit overall cash on cash yield before you get any inflation. The issue is going to be if you don't see that inflation and interest rates do move up, you could have some challenges there if you have to be a seller. If you have the ability to hold long and you're buying at these low rates and financing low, you'll probably be okay.
Lauren, what's your sense?
No, I agree. And I think Adam brought up a point that maybe is not talked about, quite enough, which is supply or construction cost increases, right? In many of these multifamily markets, some of the markets you referenced in the Sun Belt, demand hasn't tended to be the issue. The issue has been when supply has really caught up and leapfrogged demand. And I think the fact that construction costs have really skyrocketed to such a degree, replacement cost has increased, should be a mitigant on excess supply, which is supportive of asset values.
Just real quick before we wrap up here, I'm wondering what kind of returns both of you are expecting in the year ahead. Substantially lower than what we've seen, about the same, or more? Adam?
I would say lower than what we've seen. But Lauren, what did you say, 13% year-over-year growth, roughly?
I think I said for industrial, 23%. So
23, okay. Yeah, I would say lower then.
Okay, so lower, but are you talking like 22%? Are you talking, we're going to be much lower?
Again, right, we've got 10-year treasury at 1.5%, inflation running, whatever you want to call it, high 2s to 5%. 5% is probably not the run rate. Is high 2s the run rate? Probably. We think rates are going to go up. I think the rental growth will offset the fact that yields are going to go up, meaning multiples go down. So I still think valuations are probably positive over the next year, but I think it's single digits if you had to pin me to a number.
Yeah,
Lauren, you agree?
The last 12 months have had pretty stunning returns for industrial, residential, life science. We think that there's still positive return from here. I agree, high single digits types of returns, but I think, some deceleration is probably the right base case assumption.
Lauren, Adam, thank you so much for taking the time today. We really appreciate it, and have a great rest of the week and weekend. Take care.
Thank you so much.
That's a wrap for Bloomberg Invest Global. We hope you enjoy the conversations and found the information and insights useful. On behalf of the team here at Bloomberg, I would like to thank our speakers for such a wonderful program. I'd also like to thank U.S. presenting sponsor Invesco QQQ and our presenting sponsors, Abu Dhabi Investment Office, Angola's Investment and Export Promotion Agency, Grayscale Investments, Do Business Jamaica, Letter One, Qatar Financial Center, and our supporting sponsor, CMC Markets Connect, for making this virtual summit possible. If you'd like more information, please visit the resources tab on your screen about our sponsors. Most of all, thank you for being such an engaged audience. We're so pleased that you could join us. I'm Shanali Basak with Bloomberg News. Thank you for watching.